So there's an enormous amount of pressure on the Fed right now that cannot be ignored.
This is the toughest position the Fed has basically ever been in.
This is a Fed that's setting up to look through maybe multiple months of some stronger inflation data.
There's a big story in inflation that needs to be spelled out.
We're getting really excited about a cut in September when we've got a lot of data still to come.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, turmoil at the Fed. Equity markets are inching lower and long bond yields inching higher as President Donald Trump attempts to fire Fed Governor Lisa Cook. Governor Cook is firing back, insisting the president doesn't have the authority. The pressure keeps on building.
I think it's so notable that it's turmoil at the Fed, to your point, but not turmoil in these markets. The language you used, John, inching. For now, it is a market, and the words of Man Group that I was speaking to earlier, that is just basically trading this as if the Fed is going to be more dovish. The Fed has already turned more dovish. Powell seems to have pivoted. Cook herself was leaning more dovish. They have Stephen Myron. What if this is more than just about trying to get cuts from the Fed?
The president believes he's got the authority to fire the governor of the Federal Reserve. Governor Cook believes that he doesn't. There's a process that's got to play out here. This is going to take potentially a long time. In the meantime, we've got to think about institutional credibility and resilience. I go back to Stephen Moore, 2019, nominated for a position on the Federal Reserve Board. Republican Senate didn't even take it up, had to withdraw the nomination. You've got to remember here that the list we've got from the Federal Reserve for the Federal Reserve chair at the moment is quite credible. From the President of the United States and Secretary Scott Bessent. And if we do get further down the line and we do have to replace Governor Cook, and there's a lot of ifs there, who's to say that it's going to be someone that scares this market?
I think that is incredibly valid and potentially part of the reason why the market hasn't been moving. Still, there's been a lot of commentary out there that some of the authority of the Fed is being bent. Certainly not broken, but if you just get those inching away at the margins, do we all become boiling frogs in the pot? Do we all of a sudden become blind to when you do have a Fed that's been remade, that is more willing to do things like potentially try to tweak at the margin what the long end of the curve is doing to get mortgage rates done? Is that disaster for this market? Maybe not, but it is small things stacked on top of each other.
We are testing the limits of institutional resilience, that's for sure. You've picked up on the long end of the curve. I'm right there with you. Bond yields are a little bit higher this morning by 4 basis points, but it's just how this curve continues to evolve. Steeper, steeper, steeper.
Yeah, and it's notable that this morning it's also happening with a front end that is rallying. Again, it's a market that is assuming that you're going to get a more dovish Fed with the recent changes. But what happens if you get a dovish Fed and you get a long end that sells off? We had this previously, and I should say after Powell's speech at Jackson Hole, the long end wasn't too bothered. So you get a change this time around. And the question becomes, will Trump actually get what he wants, even if he makes the Fed more dovish? This market would suggest not.
It's a question we'll ask a lot this morning. Dramatic headlines, very muted price action so far. Equity futures down by not even 0.1% on the S&P. Coming up this hour, we'll catch up with Peter Tchir of Academy as the president says he's firing Fed Governor Lisa Cook. Sree Kochugovindan of Abrdn joins us on the future of Fed independence, and Marissa Adams of HSBC on this week's trade headlines. We begin this hour with our top story. President Donald Trump making a move to fire Fed Governor Lisa Cook. Annmarie joins us now from Washington with more. Morning, Annmarie.
Good morning, John. A significant development overnight as we've seen the president not just talk about in this rhetoric that he wants to oust Governor Cook, but putting out a letter that he says he has cause to remove her. Jonathan, when it comes to cause in the Federal Reserve Act, this would mean malfeasance, dereliction of duty while in office. I'm sure you've seen the statement from Governor Cook. She says she is going to fight this. She says no cause exists and he has no authority to do so. So as you correctly said at the top of the program, there is a process that now needs to take place. We have seen Lisa Cook retain a lawyer for this. And I would go back to the signal we received from this Supreme Court in May. It basically signaled that officials at an institution like the Federal Reserve have more cover. This is the key quote from that Supreme Court. Talking about the Fed is a uniquely structured quasi-private entity that follows in the distinct historical tradition of the first and second banks of the United States, basically saying that when it comes to officials at the Federal Reserve, when it comes to this presidency, they are going to be potentially out of reach.
Annmarie, with the latest down in Washington, D.C. Annmarie, will have more throughout the next hour and beyond. Joining us now around the table here in New York City, Peter Tchir of Academy Securities. Pete, good morning. Good to see you.
Good morning.
We talked about it at the top, me and Danny. We've got some very dramatic headlines, some very muted price action. What explains the difference between the two?
One, I think we've all seen kind of this progression to the Fed being more dovish anyway, so whether this changes much, I don't know. But I think the market might be getting wrong, and I'm still not quite there yet myself, is we should stop fixating on rate cuts, what this means for rate cuts. I think, what is this going to do for the longer end of the curve? And what is the Fed and the Treasury Department going to do to prevent, kind of a repeat of last September? And I think that's what the market's got to start thinking about is everyone's well aware that last September they cut rates, long ends rose, we're getting this kind of constant steepening. I think 2s, 30s are now at the steepest level they've been in a while. The Fed's not silly. Besant's not silly, right? They've got to be looking at this. I expect to see a little bit more done to control the long end of the yield curve this time and maybe even help the mortgage market. Because again, this administration has talked, Besant had his 3-3-3 strategy is about getting 10s below 3%. We haven't made a lot of progress there. I think that's next on the agenda.
493 on 30s. What does corrective action look like?
I think people are going to push that higher. I think people are, very concerned about a Fed that all of a sudden doesn't behave maybe as we thought. I think that's going to turn out to be a mistake. I think a lot is going to be done, whether the Treasury reduces issuance, whether we get an Operation Twist, whether we get chatter about maybe we go back to buying mortgages out of the Fed and switching some of their portfolio mix around. I think there's going to be a lot done to try and control that. I think by the end of the year, we're at 450 on 30s, maybe even 425. And I do think we get back below 4% on 10s.
Is that going to be a willing Fed that does something like that? Or how does it change to allow that process to take place?
Well, I guess probably the more changes that occur within the Fed, the more willing it'll be to do that. And again, I think Besant has a bunch of control of what he can do in terms of issuance on the Treasury side. So I do think it's going to be a more, intertwined Fed and Treasury where they do work a little bit together. Again, if you kind of think about it, we saw during the, GFC or whatever, post-GFC and post-COVID, controlling yields through the short end is kind of a very inefficient way to get anything done, right? It doesn't translate well to the market. The average mortgage, everyone during, COVID went long-term, except for the U.S. government. The U.S. government was the only one who borrowed short-term, but corporations did it, individuals did it. So fiddling around with short end doesn't help that much anymore, I think.
So all of this is happening, and you say the wrong concentration is about how dovish or whether the Fed will cut. But Peter, what does this do to the data we are about to get over the next month? Just how crucial does a data release become for CPI and unemployment, especially if those things come in hot?
And I have no idea what this jobs number is going to come in. I go back to July 3rd, I was on a plane coming back. I thought June data was going to be weak. Turned out strong. A month later, we found out it actually was weak. So I think there's this degree of randomness that's showing up in all the data. So I'm not even sure anymore how the market's going to trust whether we get a strong jobs report on September. You would think a month ago we would have sold off hard on yields because, now the Fed can't cut. I don't know that that's going to happen. So I feel the data is going to be noisy, and then we're going to forget it within hours now and go back to, no, this Fed's probably going to be cutting because that's the path we're on.
Where does that leave foreign exchange? Put everything you've just said together, the various points you've made, and for me, at least, listening to you, it screams weaker dollar.
I'm exactly there, right? If you're kind of pushing on all these other things, like the balloon, right? The bubble's got to go somewhere. So I think it's going to be continued weakness in the dollar. I think you'll see DXY, it's a little bit weaker today. I think that continues lower and lower because all these things that we would do, I think will be anti-dollar, kind of, wanting people to truly invest here.
So bonds 1, FX 2, where does it leave stocks?
I think we meander along right now. I think what I'm starting to look to is I want to own, the small caps. I think they should benefit from some of this. And I feel we've had this huge run on the data and the AI. And, we are going to continue to grow on data and AI. Data centers, people want that. It's weird, but it's starting to feel to me like we are paying 2030 prices for 2025 technology. And it reminds me a lot when we went through the broadband and fiber build out. The companies were all superstars. They were doing great. They all got in trouble because there was a bit of an overbuild. Then eventually all that fiber got used and the companies did well. And I feel like we might be at that tipping point where I think you mentioned on the show earlier, right? If you spend $10 billion, your stock goes up by $20 billion. So why wouldn't you just spend? If you start getting a different reaction function, and weirdly enough, I still wind up liking Chinese stocks. And it seems so crazy that we're having all this fight with China. We talk about it all the time. China this, China that. China's economy is weak. Yet FXI has outperformed the NASDAQ 100 this year, which seems bizarre. And I think that can continue as China continues to try and wade through this, tariff policy. And they have been consistent in their message. And they're consistent in what their plan is. And it's been rewarding shareholders, bizarrely.
Just on the idea of stocks and any sort of rotation we might have, Peter, why be anything other than completely bullish on the entirety of the market if we are getting cuts?
And maybe I've got to, just get into that, but it feels like we've had this run up already in stocks, right? We've been running up a little bit in anticipation of all these cuts. And to me, you just go back. It's the AI spend has been kind of the biggest surprise, I think, in the economy this year. We can talk about tariff pauses, all those things. That all helped the market along. But to me, the big thing was just how consistent the AI spending was, that every single corporation in America felt that no matter the state of the economy, we want to be into AI because we want to be more efficient. And if that ebbs at all, I think that just is going to be the drag on stocks. And the tariff stuff, this is going to take, we've been talking about months or quarters to play out. I think you finally start seeing some of the negatives on tariffs coming through in the next few months.
Even so, even with all the hype around AI, it's probably worth taking a step back and realizing that the NASDAQ has underperformed European stocks still this year. There has been somewhat slightly of a rotation to international stocks that dominated the start of the year. That noise has quieted down. But Peter, to what degree is that trade still alive?
So I think Europe, to me, seems a bit overplayed. They're going through their own issues. They've got what's going on now. I don't think they're going to be massive beneficiaries from, peace with Russia and Ukraine. I think it will help, but it's not going to turn their economies around. It seems bizarre to me to think that Chinese stocks continue to outperform, but that's where I'm leaning. I see that as the economy that's trying to function. They've got a plan. Europe, to me, it's, they coalesced a little bit with, Russia, Ukraine, with NATO spending. But again, that seems to be, breaking a little bit apart again. So I think U.S. will actually probably outperform Europe for the rest of the year. Having said that, the dollar is the problem there, I think. It's just dollar weakness is going to hurt.
Europe's super messy. Go through the continent right now. We always talk about Europe as just sort of one thing, one monolith. But Europe's a mess. You've got countries that have got fiscal space, Germany, others that don't have any, the UK, France, and France are the epicenter of the price action in Europe this morning.
Yeah, France really under pain, but if anything, it just really highlights that it feels like the back half of this year, that fiscal dominance is the story. You have France that's trying to cut the budget, unable to do so. You have also Japan that's facing higher yields. And by the way, these are all countries whose central banks started QT at the end of last year. They're really coming under pressure now.
Multi-decade highs for some of those bond yields. Peter, it's good to see you, as always. Peter Tchir of Academy Securities. Lots of drama stateside, but very muted price action. The theme so far this morning on Bloomberg TV, equity futures negative by not even 0.1%. With an update on stories elsewhere and worldwide this morning with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. We start with President Trump moving to oust Fed Governor Lisa Cook over claims that she falsified mortgage documents. Cook responded saying that Trump has no authority to fire her and that she won't step down. The move represents a significant escalation of the president's battle against the Fed, which he says is taking too long to lower interest rates. Meanwhile, China is sending a top trade negotiator to Washington this week, a move that signals talks are progressing. The vice commerce minister will meet with trade and treasury representatives Thursday and Friday. The move comes after both sides extended their pause on higher tariffs through early November. And Elon Musk is suing Apple and OpenAI, accusing them of colluding to block rivals in the artificial intelligence market. In a federal lawsuit, Musk's X and xAI claim Apple's integration of ChatGPT into iPhones gives it an unfair monopoly and deprives consumers of choice. OpenAI dismissed the case as harassment. That's your Bloomberg brief. John.
Yahira, thank you. Appreciate it. More from Yahira a little bit later this hour. Up next on the programme, Trump and Cook facing off.
President Trump, you're going to fire Lisa Cook, the Fed governor, over her mortgage fraud?
If she doesn't resign, what she did was bad. So I'll fire her if she doesn't resign.
And that's exactly what he did. Up next on the programme, Scott Lincicome of the Cato Institute, live from New York City. You're watching Bloomberg TV. From New York City, welcome to the programme. No drama whatsoever so far this morning in the market. We're down just 0.05% on the S&P. The NASDAQ totally unchanged. If we turn to the bond market, 2-year, 10-year, 30-year, this is how things are shaping up. Bond yields creeping higher at the long end of the curve, up by 4 basis points to 492.85. Down at the front end of the curve, we're down by 2 basis points to 370. The distance between the two getting longer. The spread getting wider, the curve getting steeper. That's the theme so far this morning.
530 is the steepest since 2021, and it is worth pointing out that this has been a move that's been occurring for some time now. It didn't change with today. If anything, this speeds it up. We're just talking to Peter Tchir about this idea. What if we do get a Fed that more closely works together with the Treasury, that tries to change the steepness of this yield curve if you do have cuts that are met by higher rates, especially if there are questions of independence? It underscores already, again, a move that's been undergoing.
Just a little bit more fuel for that trade this morning. Under surveillance this morning, Trump and Cook facing off.
President Trump, you're going to fire Lisa Cook, the Fed governor, over her mortgage fraud.
If she doesn't resign, what she did was bad. So I'll fire her if she doesn't resign.
That was Friday. Here's the latest this morning. President Trump announcing he's seeking to remove Federal Reserve Governor Lisa Cook from her position due to allegations she committed mortgage fraud. Cook responding, saying the president has no cause to do so and that she would not be resigning. Bloomberg's Annmarie joins us now from D.C. with more. Hey, Annmarie.
Good morning, John. Significant escalation when it comes to the president and this standoff with Governor Lisa Cook. This really stems from FHA Director Bill Pulte talking about the fact that they think she committed mortgage fraud. These are allegations. The president, though, in his letter last night, Jonathan, saying the American people must be able to have full confidence in the honesty of the members entrusted in setting policy and overseeing the Federal Reserve. We're now joined by Scott Lincicome of the Cato Institute. He works on general economics and trade. Scott, thank you so much for joining us this morning. Just your reaction to this headline overnight.
I can't say I'm surprised, given the run-up and some of the statements from the Trump administration already. But look, that doesn't mean that this isn't a significant move. The independence of the Fed is extremely important for U.S. monetary policy and the U.S. economy. We at Cato and elsewhere have always been concerned about politicization of the Fed, but this is now going in the wrong direction, right? It is pushing us more towards politicized monetary policy. And quite frankly, it's not something that appears justified by the numbers in terms of absolutely necessitating some sort of rate cut. When you look at core CPI still above 3, flash PMI last week showing significant price pressures, the idea that this is just a recalcitrant Fed fighting the president's whims or needs is not really held up in the data.
Does the market actually believe it yet? How do you see this playing out, this fight between Governor Cook and the president of the United States?
Yeah, I think some of the calmness in the market probably stems from the fact that it's not 100% clear that they can do this. Cook and her legal team saying they're going to fight it. And that, it appears to be, I think, giving some people some thoughts that, maybe the independence of the Fed's still intact. But that being said, look, Trump is a persistent guy. We know this. And I don't think we should be too confident that this is going away anytime soon, regardless of how this particular spat turns out.
Whether it's the Fed or whether it's trade, we'd like to see the president of the United States put his thumb on the scale. He takes an interventionist approach. You wrote about that this week in the Washington Post when it comes to Intel. What kind of precedent do you see Trump setting for future administrations?
Well, it's a lot of troubling precedent. Beyond the pressuring the Fed, now, you have the state taking big stakes in private companies like Intel, not during the Great Recession or wartime, but in peacetime, and doing it under a pretty clear pressure and coercion from the Oval Office. Of course, you have all the import substitution in tariffs and uncertainty in trade deals, which is also all executive power as well. It makes you wonder where the heck Congress is all in this. But it also makes you think what the next president's going to be able to do. Bernie Sanders was cheering Trump's Intel move, and you could very well have a Democratic president that picks up these very same precedents and pushes even further into an interventionist executive branch acting unilaterally. And that's, of course, going to raise serious issues, serious problems for the health of the U.S. economy.
Well, the president also said he would be interested in maybe striking more deals like this. Are there companies that you're looking at that potentially we can see a similar approach from this White House?
Yeah, as I wrote in the Post, if any company that's taken subsidies from the U.S. government and happens to be located in a strategic industry, by the executive branch's definition, should be a little bit concerned. The fact is that we now have national security investigations in the trade space on a whole lot of products, not just chips and steel and aluminum and others. We've already seen a golden share for U.S. Steel. We've already seen investments in MP Materials, which is in the rare earth space. So I think there's no question that companies that have some sort of dealings with the U.S. government in these strategic industries may be the next to get a call from the Oval Office.
Trump has talked about building, though, a U.S. sovereign wealth fund. Is that what all of this is leading towards?
Well, NEC Director Kevin Hassett basically said as much yesterday, that they're using a lot of the industrial policy that was implemented during the Biden years through the Inflation Reduction Act, the CHIPS Act, the infrastructure bill, and some other executive authorities to basically reverse engineer a sovereign wealth fund, which Trump has long wanted. And this, again, I think is a concern for companies that have taken some of these, ups of trillions of dollars in government subsidies. But it's also, I think, a cautionary tale about U.S. industrial policy generally, how this stuff maybe starts targeted but tends to have a way to spiral out of control.
Scott, I just want to end on another truth last night from the president, not getting as much attention what's going on at the Federal Reserve. He said he's going to stand up to countries that attacked U.S. tech because of things like digital services. What does this mean for the European Union, given the fact that the president has already struck a trade deal with them?
Well, I think it should tell the European Union, Japan, and anybody else that these trade deals that they signed over the last couple months are never really finished. Digital services taxes were supposed to be an issue in the EU negotiations. The Europeans resisted any changes. They signed this big deal, which most people saw as a pretty huge cave by the Europeans. And here we are just a couple weeks later, and Trump's asking for more. So, for those who think, especially in the market, who think these trade deals have settled down the tariff space, think again.
Yeah, that's certainly right. Doesn't feel like the tariff story is going to be ending anytime soon. Another 3.5 years of maybe some more tit for tat on the trade front. Scott, thank you so much for joining us. That was the Cato Institute's Scott Lincicome, Jonathan. And he makes the point, really, what the president is doing, whether or not it's the Fed, whether or not it's trade, taking a stake in Intel. It's the president that this sets for potentially future administration. And Scott was pointing to the fact that Senator Bernie Sanders was actually welcoming what this White House did when it comes to Intel.
Annmarie, with the latest down in Washington. Annmarie, thank you. Turning the CHIPS Act into an investment vehicle. We've got a very activist investor in the White House who's saying we're taking a passive stake. I'm not so sure about that over the next few months.
How can it be when he summoned the CEO of Intel to the White House just before this happened? What does it also mean for other tech companies here in the U.S.? Does all of a sudden Intel get favored above them? It raises a lot of questions, not least of which, to Scott's point, it takes more than 4 years often to build out these types of businesses and foundries. So what happens when it's a different president in the White House?
We were already worried about a misallocation of resources in this sector and beyond, and I imagine that worry has got some extra fuel over the last few weeks or so. What a month we've seen through the month of August. Still got a few more days to go. Equity futures at the moment on the S&P down by about 0.1%. Intel down by 0.2 in the pre-market. Coming up on the programme, we'll catch up with Sree, Kochugovindan of Abrdn on President Trump's push to reshape the Federal Reserve. Plus, we'll touch base with Yahara again and get you some morning movers. Boeing landing a multi-billion-dollar deal from Korean Air. That stock is up by 0.6%. From New York City this morning, good morning. Bit of a sleepy Tuesday. Lots of headlines to get through, but check this out. We're going absolutely nowhere on the Nasdaq, and likewise on the S&P 500. The S&P negative by not even 0.1%. If you want some price action, switch up the board and get to the bond market. Check out 2s, 10s and 30s. Bond yields higher at the long end, lower at the front end. This curve is steeper. We're down 2 on 2s to 370. We're up 4 on 30s to 493. And Danny, like you, was the thing I was looking at first thing this morning. This curve getting steeper.
Yeah, because also the dollar isn't reacting to the point where even George Saravoilis of Deutsche Bank putting out a note this morning saying he can see no reasonable way and why the risk wouldn't be priced in. It is being executed through the bond market. The nerves of what it means going forward if you get a Fed that's cutting. Perhaps it's reflecting fears of inflation. Maybe it's reflecting fears of independence. Maybe it's reflecting an idea that you could get more action from both the Treasury and the Fed to try to change the shape of the bond curve. This is a Fed that has done QE before. In order to do that, nothing would necessarily stop them from doing it again.
We'll come back to this 30s this morning at 493 with 3 hours until the opening bell, 6:30 Eastern time. Waiting for the cash open about 3 hours from now. With your morning movers, here's Yahira. Hey, Yahira.
Hi, John. As I've said before, Boeing has emerged as one of the biggest winners of President Trump's trade wars. And this news here confirms that we are seeing shares up about 0.6% after South Korea announced $50 billion in deals with U.S. firms as part of its trade deal. And included in that is a $36 billion order for more than 100 Boeing jets. GE Vernova is also emerging as a winner in this latest trade deal. And we move on to shares of the retail trading platform Interactive Brokers. They are rising nearly 4% on news that it is joining the S&P 500, which of course usually means a rush of demand by index funds. The changes are set to happen on Thursday before the market opens, and it is set to replace Walgreens, which is going private. And we end on VF Corp. This is the company behind Vans, and the North Face shares are rising 2.4% on some sell-side action. Baird is upgrading it to outperform and lifting its price target to $20. They're saying their shoe brand Vans is finally turning a corner, and the cost cuts that it's been trying to implement are starting to kick in, but tariffs are still a major overhang on this company. When it reported 2Q results back in July, it said that tariffs could shave off about $60 to $70 million off of its profits this year. John?
Our stock's up by 2.4%. Yahira, thank you. More from Yahira in just a moment. On our radar this morning, our top story, President Donald Trump moving to oust Fed Governor Lisa Cook after claims she falsified mortgage documents. Cook responding that Trump has no authority to fire her and that she won't step down.
And the fact that the dollar and treasuries didn't dramatic weakenly just show that there's some nerves about the latest developments, but not freaking out yet. Presumably, again, on this assumption that the firing won't stick. She hasn't formally been charged with anything, as we've been discussing. I think part of the interesting thing will be to see how the Fed, the board, the FOMC itself starts to react from this. This is a Powell that didn't stand in the way, for example, of ethical concerns about Kaplan when he decided to resign, or Rosengren. The key is, what do they do now? Do they treat Cook as just a normal member of the board? What happens if a lawsuit is hanging and clouding over this Fed as they continue to make rate decisions? Again, there's been a lot of talk about this being a make or break moment for the Fed. How did they react with a Fed which, by the way, didn't want to talk about the politics or independence at all at Jackson Hole?
America is not Turkey. I think we should point that out too. If you go back to when Erdogan ousted the central bank governor a number of years ago, I think spring 21, something like that. Got to go back 4 years. When we saw that happen, it was immediate. There was no pushback, there was no process, and we saw the immediate reaction in foreign exchange as well. The process here is very different. This is going to take a long time to play out. Both the president pushing and pursuing the ousting of Governor Cook, but also a legal process over these mortgage fraud allegations that hasn't still officially opened.
And to your point, even if Cook is gone, the list of candidates that we've seen for Fed chair have been very credible. There's no reason to suggest it wouldn't be the same. The issue, though, comes even if you have someone credible leading the Fed. Let's say you have Waller, who has very clear and articulate reasons for cutting. Is it a market that looks past that and says, this is an FOMC, which is mostly Trump appointees? It doesn't matter why you say why you're cutting. We think it's for political reasons, and therefore the long end is unattractive.
Mike McKee is standing by. We'll turn to Mike in just a moment. I want to get you up to speed on the turmoil over in Europe. French Prime Minister Francois Bayrou calling for a confidence vote that could topple France's government as soon soon as next month. Parties across the political spectrum saying they'd vote against the measure, which could force his resignation.
Another French government potentially collapsing only 8 months after it happened, with Michel Barnier only serving for 90 days. It's important why this vote is happening, though. It's because Bayrou wanted fiscal tightening. He wanted cuts and tax increases, something of the like of 44 billion euros. But it's a populace and a rest of the government that finds that so unsavory. But it is a lot of places that are really struggling with this, that they need to find fiscal headspace, but they're getting pushback from other people in power and populations too. So what happens? Again, it comes back to the story that we've been discussing. It is a bond market that is looking increasingly unsavory if they can't find that.
Think this through. What would make it politically palatable? What would make it palatable, not just for the French, but for the Brits as well, for the UK, where we've seen a similar dynamic play out? What would it take for them to vote for this? They're not going to vote for this until the alternative is worse. Just think that through. They're not going to vote for this until the alternative is worse. That means it's not bond yields where they're at right now. It's bond yields a whole lot higher from here. Now, I'm not going to be particularly helpful from here because I'm going to say I've got no idea when that's going to happen. But ultimately, that's how the stage is set here, both for the UK, for the French and for others. With limited fiscal space, you're not going to get politicians to vote for what is good for the health of the fiscal balance sheet and the standing of France and other countries too, until the alternative is viewed as worse, and we're not there yet.
I think it's helpful, though, to look at historical examples where this has happened to get a gauge of that. And, of course, the most recent one is the UK and the turmoil there over Liz Truss's budget. But it's really important to underscore, for all the crying that bond vigilantes are the ones that can step in and change policy, it wasn't bond vigilantes. It was a break for a mechanical reason having to do with the pensions in the UK. Yep. It wasn't all of a sudden investors coming in and pushing back, so saying, OK, the alternative is worse. The alternative hasn't really presented itself of a bond market that's shown the ability to do that, again, unless it's a mechanical thing that was out of the hands of individual traders.
Something somewhere has to break, and right now it hasn't broken. And if you're worried about what that might look like, so am I. So am I, because they keep tempting fate. They keep pushing it, and the French are not the only ones. Let's turn to China, sending a senior trade negotiator to Washington for talks with the US officials later on this week. The discussions signaled ongoing progress following President Trump's extension of the tariff truce between the two countries. The Treasury playing this down.
Yeah, they're really playing it down, saying that the conversations won't be happening at the highest level, that the US didn't ask for this meeting either. But it does underscore the trouble with can kicking. Nothing is actually resolved, and it constantly leaves the threats of escalation. It seems that some of this conversation might surround soybeans. It was a president that earlier this month said that China wasn't buying enough. The president also threatening to say we need more magnets, and we could place as high as 200% tariffs on China if we don't get that. So the issues that we thought maybe were behind us, again, the fact that there's been no resolution with China and it's just extension after extension does leave escalation as a threat.
It's hard to keep up in Washington at the moment. Let's turn back to our top story. President Donald Trump moving to fire Fed Governor Lisa Cook. Bloomberg's Mike McKee, back from Jackson Hole, joins us now for more. Mike McKee, you were expecting this, and here it is.
Yes, here it is. And the interesting question this morning is, Donald Trump says Lisa Cook is fired. Lisa Cook says, no, I'm not. Is she fired? We don't know at this point. And we don't know whether this will go to court or how it will go to court, other than if Lisa Cook does have to go to court, she'll do it on her own. The Fed, because this is a personal issue of the mortgages, the Fed can't really be involved unless they see it as a threat to the Fed itself, which you can make that argument, in which case they can sort of file a friend of the court brief to try to stop this. So we don't know where this goes from here this morning.
Mike, you were in Jackson Hole. How was this story playing out at the time just a few days ago?
Well, there were obviously a lot of people talking about this. This was all the talk outside of the meeting room. Everybody concerned with what it might mean for them. I talked to a number of Fed officials who say, yeah, I believe they could be coming after me, too. Austin Goolsbee had the best response. The Chicago Fed president said, I've lived here for 30 years and I paid off my mortgage, so I'm not worried. But others are to an extent. And then you have the tinfoil hat theory about a Trump-controlled board firing all of the regional Fed bank presidents. And some Fed officials say they wouldn't put it past the president to try that. So it's obviously a matter of concern to everyone there.
Mike, I think there has to be a little bit of pushback there on that majority of the governors pushing back and firing regional Fed presidents. Mike, you know Governor Waller, Governor Mickey Bowman well. Do they sound like political puppets that would pursue those kind of things?
No, I don't think that's the case, particularly with Chris Waller. But I did talk to some people who think that the pressure on them might get them to do something like that. But I think that would be a very long shot.
Mike McKee. Stay close, Mike. Lots to talk about throughout this morning. Mike McKee, good to have him back in New York City. Sree Kochugovindan of Abrdn warning that President Trump's push to fire Fed Governor Lisa Cook could feed into higher term premia across US Treasuries and undermine the US dollar. Sree joins us now for more. Sree, good morning. Are you seeing some limited signs of that so far this morning?
I think so. We're seeing over the last few days, actually, we've seen, this trend towards steeper curves. So what we saw on Friday was obviously a response to the Jackson Hole. Now, today, we are starting to see the impact of this announcement by President Trump. And that's set to be a long, ongoing process. This is not an overnight issue. This is something that we've seen as quite a pivotal moment where President Trump has been talking about firing officials and taking greater control over the Fed. Now he's actually trying to do that. He's attempting to do that. And as we've already heard, this will be a long process that goes through the courts. This is a lot of pressure on Governor Cook over the coming weeks, obviously. Now, what we're also seeing is that if Governor Cook is pressured to resign or eventually fired, what does that mean for the Fed? It tips the balance from a fairly balanced and nuanced Fed towards a dovish majority. It's most likely that the replacement for Governor Cook is going to be another dove. And we've seen this public sort of pressure on the Fed, whether it's Treasury Secretary Bessent publicly calling for a 50 basis point cut, or this push for getting Stephen Moran into place very quickly and pushing that through the Senate. So there is a lot of moving parts here that are starting to suggest that the Fed is under a lot of pressure in terms of the future policy path. Now, there is no way that the bond market will completely ignore this. I think at the moment it's a case of, well, what's actually happening? Is this possible in the courts? There are checks and balances in terms of the Fed. This is very different to cabinet members. There are checks and balances here, and it's an ongoing process. So I think at the moment, stability in the markets could literally be a case of, well, let's see what's actually happening here. But longer term, this does signal higher risk premium. If there is a threat to Fed independence and Fed credibility, that could be a problem for the longer end of the yield curve.
Sree, though, if we do have a Governor Cook that leaves and is replaced with someone who is dovish, what difference would that actually make? In fact, it was a Governor Cook who, before this all kicked off, had been expressing concerns about the labor market and herself been leaning more dovish.
That is true. That is the case. And I think what's been interesting is this shift from Chair Powell himself. Prior to Jackson Hole on Friday, we had been seeing greater emphasis on the inflationary pressures coming through tariffs. Now, there was a distinct shift from Powell himself. So again, that could be, there is some speculation whether this is due to political pressure. And we are seeing that there is some weakness in the data being signaled in payrolls, but that was quite a sudden shift in his tone and in his communication. So what we are seeing is that in the next few weeks, I think it could be quite critical to watch the key data that's coming out. We have payrolls, obviously, in a week's time. We have benchmark NFP revisions as well, taking the preliminary revisions for March 2025 and the final revisions for the year before. So these will be quite important alongside the CPI print. So this is still, from the messaging on Friday, we still saw data dependence, although the nuance has shifted quite quickly towards the labor market dynamic. So now the labor market is the swing factor rather than inflation. They haven't completely closed the door on a hold, I would like to point out. They have highlighted, Chair Powell did continue to highlight that the tariff impact will filter through into inflation, but now the emphasis is that it will be over time, staggered across time and sectors, but also that it is more of a price level shift. Now, obviously for the Fed, if this filters through into inflation expectations, then that takes on a different turn. But they're not mentioning that. They're not talking about that too much. It's more of a focus on the labor market. And I think that shift in tone is very interesting to watch as well.
Hey, Sree, thanks for making time for us. Appreciate it. And for explaining your view. Sree Kochugovindan there of Abrdn on this bond market and a little bit more. 30-year bond yields this morning at 4 basis points, 4.93. With an update on stories worldwide with your Bloomberg brief. Back with us, here's Yahira. Hey, Yahira.
Hi, John. President Trump says Vladimir Putin's personal dislike of Ukraine's Volodymyr Zelensky is stalling a meeting between the two leaders. The White House previously said Putin agreed to a meeting with the Ukrainian president, and that planning was underway, but the Kremlin never confirmed their commitment, and no summit has yet been scheduled. Meanwhile, back here in the U.S., President Trump has called Chicago a mess and threatened to tap the National Guard to tackle crime in the city, expanding his crime crackdown beyond Washington, D.C. Chicago's mayor said Trump's plan is unconstitutional and a threat to democracy, and noted that murders in the city have fallen to the lowest in more than a decade. And I mentioned this story earlier. Korean Airlines plans to order more than 100 Boeing jets worth more than $36 billion. That's in addition to a $13 billion with GE Aerospace. Korea Air's CEO is hailing the deal as a, quote, pivotal moment in the airline's plans to modernize its fleet. The announcement follows the South Korean president's visit to the White House yesterday. That's your Bloomberg brief. John?
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next on the program, more trade talks on the way.
I spoke to President Xi fairly recently, and at some point, probably during this year or shortly thereafter, we'll go to China. In terms of playing the cards, we have much bigger and better cards than they do. But with that being said, I think we have a great relationship.
That conversation up next with Marissa Adams of HSBC. Equities at the moment, a little changed on the S&P 500 and on the Nasdaq 100. In the bond market, a little bit of change. Bond yields are higher at the long end of the curve. Mike McKee put it well. The president says Governor Cook is fired and Governor Cook says she's not. So where does that leave things?
It leaves things hanging in limbo and potentially a lawsuit that hangs over this Fed as they try to do their dovish pivot. Again, it feels ridiculous. We got this whole Jackson Hole speech where independence wasn't mentioned at all. And 3 days later, you have a president attempting to fire a Federal Reserve governor.
It was certainly the elephant in the room at the time. Annmarie's on the ground in Washington. More from AMH later on this morning. Plus, don't miss this, the former Fed Vice Chair, Lael Brainard, joining us at about 8:15 Eastern Time. Under surveillance this morning, more trade talks on the way.
I spoke to President Xi fairly recently, and at some point, probably during this year or shortly thereafter, we'll go to China. And I think we're going to see a magnificent sight. It's a great country. In terms of playing the cards, we have much bigger and better cards than they do. But with that being said, I think we have a great relationship.
So here's the latest this morning. China sending its senior trade negotiator to Washington for talks this week. Key trade deadlines also looming, with 50% tariffs on India beginning tomorrow, followed by the end of the de minimis exemptions on Friday. To discuss is Marissa Adams of HSBC. Marissa, welcome back to the program. So this is where things stand. More deadlines for trade negotiations. We've also got to find out whether these tariffs actually stand up to legal scrutiny in the coming days. And with that in mind, we're all wondering, what is the approach from corporations, Marissa, that you speak to every single day? Are they doing short-term fixes, or are they beginning to implement long-term strategies?
Thanks, Jonathan, and thanks, Danny, for having me again this morning. So we continue to have a lot of conversations with our clients and corporates, both here in Europe and across the Americas, in particular in the United States. And corporates are still very much in a wait and watch mode in terms of long-term investment. And we think that that's only so much longer they can do that, to hold off on those investments. Now, what they've continued to do is to bring shipments forward, particularly in the consumer goods sector. We saw a lot of the industrial shipments come forward earlier in the year. But in the consumer sector, to give you an example, the Port of Los Angeles, which is one of the largest ports for imports into the United States, had its record month ever in July. So really, they are continuing to take those shorter-term moves, but soon they will need to start looking at the longer-term investments. They are also starting to look, the corporates that I'd say are very much best in class and leading, at both new demand markets, but also taking a look again at their supply chain mapping to really see where there's opportunities to grow, even in an uncertain environment before the tariffs actually are finalized.
So as they move to do that, they now face an increased level of bureaucracy, more paperwork, trying to figure out what custom charges look like. Marissa, beyond just higher prices for things, what level of friction has been introduced to the system, and how are companies coping with that?
And I'm so excited that you mentioned the word friction, because we look at the de minimis rules, which you flashed on the headline coming up on Friday. The de minimis rules, just as a bit of a reminder, $800 is what the U.S. has said you don't have to previously have to go through customs duties. Similar countries have actually been a lot lower. So the UK is 135 pounds, the European Union 150 euros, and actually they're looking to eliminate that completely as well. But that accounts for almost 1.4 trillion packages a day coming into direct to consumers, and not always direct to consumers, also through corporates, about 4 million packages each day. The question is that if you have to put all of those through a process, firstly, can U.S. Customs and Border Protection process that in the same efficiency from a manner perspective? But also, a lot of these businesses, particularly under that value, will never have had to go through a customs process. So it is likely to introduce quite a bit of friction, and also, a lesser customer experience. But for a lot of these businesses, too, that are really low margin, any sort of change in both the friction in terms of the time of processing, but also the additional cost, can really mean the success or really pivoting of those businesses going forward. Now, what we are seeing is that businesses, particularly in the U.S., and we did our survey of customers, about 5,000 customers globally, about 1,000 in the United States about a month ago, and we see that 75% of them are looking at innovation. So much of that also pivot is towards services, which I think is something that at this stage has not yet really been impacted by the tariffs.
Marissa, what does that look like? What does it look like, the distinguishing factor between a company who can innovate, who can find ways to deal with, as we've been talking about, this friction, and those that can't?
Scale, really. So if we look at sort of larger corporates throughout the United States who already have had those experiences, they clearly have that optionality. I think the other interesting thing is that any corporates that were around in COVID, which obviously the larger ones were, have already gone through a shock to the system. Where you have new companies that haven't quite had that shock, that will also be a challenge for them as well.
Marissa, you're one of the best. The clinic, as always. It's good to hear from you. Marissa Adams there of HSBC, one of the regional heads overseeing trade solutions over at HSBC, breaking down the difficulty of being a corporation trying to operate across several markets at the moment.
I really think that's why Walmart earnings were so instructive last week, because as Marissa said, you need scale. Who is a better example of scale than Walmart? And yet it was a company that said that they're facing increased costs every single week. What happens if you don't have the scale of Walmart? How do you cope with this environment?
Beyond that, you and I talked about this last week, even for the Walmarts of this world, how much longer can they hold off before they start either doing something on the cost side or passing those high costs on?
Right. At some point, they're going to run out of the inventory that they've stocked up, because we saw that happening. They brought a lot of goods forward. At this point, do they start to run low? And then do they need to start purchasing things at post-tariff prices? Which, by the way, it's not completely clear what some of those might be if you still have negotiations ongoing with China and representatives coming to the U.S. with issues over EU digital taxes. There's a lot of shifting sands. And again, I go back to George Surveillance, who says that those shifts are not priced into this market.
That's the latest on trade this morning. Speaking of this market, really snoozy price action, given the discussions that we're having at the moment. Futures going nowhere. Bond yields a bit higher by 4 basis points on 30s to about 4.93. Still a lot to discuss this morning. Up next on the programme, we'll catch up with Matt Miskin of John Hancock, Michael Townsend of Charles Schwab, the former New York Fed President Bill Dudley, and Jim Bianco of Bianco Research. With equities going nowhere, the bond market going somewhere with yields higher by 4 basis points on 30s and down 2 on 2-year bond yields. The president says Lisa Cook is fired, and Lisa Cook, the Fed governor, says she's not. The debate continues from New York. You're watching Bloomberg TV.
The market will have to digest the fact that, okay, the economy is now cooling quite a bit.
We would expect to see a little bit of a growth slowdown in the beginning of next year.
Bonds here look like a good buy. Stocks have done so much better than bonds over the past several years, and that gap's going to close.
In the near term, there's going to be some volatility.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures going absolutely nowhere. Futures unchanged on the S&P 500, on the Nasdaq 100 as this rally stalls over the past 24 hours. In the bond market, this curve is steeper. 2-year bond yields are down by 2 basis points. 30-year bond yields are up by 492.95 as the pressure continues to build on the Federal Reserve.
This is a story that's not going anywhere, with Trump attempting to fire Lisa Cook. Lisa Cook saying that he doesn't have the authority to do so. It's going to be an ongoing court case, most likely, a cloud that hangs over the Federal Reserve. And maybe that's why you're not seeing as much of a reaction in equities, in the dollar, because she hasn't been formally charged with anything. It's not clear that she will actually be exiting. What it does do is, at the margins, play with some of the entrenched expectations of things like norms and institutional integrity. But again, that's just happening at the margins. It's not enough for a market to see this as an event that is breaking it.
To your point on the legal issues, and I'm so pleased we keep going back to this, still no formal process has started, but the potential that we have legal proceedings across 2 tracks. Can the president fire a sitting Fed governor? 1. And will we get official legal proceedings over the allegations of mortgage fraud? And for the time being, if you're in the market right now, you're just thinking, okay, additional pressure. But this could go on for months and months and months. Lisa Cook's term goes to when? The 2030s? It's going to take a long, long time.
2038. But also, if you're getting that pressure ongoing in the background, does that change how we view potential rate cuts? If you get shifts, more dovish from various Fed officials, does it cloud it? Of course, this is a body and very credible people on the FOMC who likely would not be succumbing to the politics, but does it just change how we view it? Also, John, can you imagine if we get a really hot CPI print in the next month, what that would do? And if you maybe get Fed officials who still cut anyway because of the issues in the labor market, do we worry about independence? Or what if it's hot and they don't cut? What does that do to the White House's reaction? I think it makes the data all the more important.
The optics matter. I totally agree with you. But for us sitting here, looking at the data and recent communication, this is the direction of travel for the committee. Has had a dovish bias for a while. The Fed chair spoke on Friday, basically said this is where we're going into September, setting them up to cut interest rates.
I do, though, just have Bruce Kassman of JP Morgan that we spoke to last week just playing over and over in my head. The idea that he brought up was this is a finely balanced decision and there are plenty of legitimate reasons to cut. But if you add to that the government pressure and concerns about independence, why wouldn't you move in that direction? Powell just helping this FOMC along to face less pressure from the White House. And Bruce called it right. We did get that pivot. The sad thing is if that was part of the reasons that they pivoted, it clearly didn't help them.
We are testing the limits of institutional resilience. We've said that a few times already this morning. Equity futures on the S&P negative by just 0.1%. Coming up this hour, we'll catch up with Matt Miskin of John Hancock on growing turmoil at the Federal Reserve. Bill Dudley, the former New York Fed president, on challenges to the central bank's independence, and Jim Bianco of Bianco Research with reaction from the bond market. We begin this hour with our top story. The president ramping up the attacks on the Federal Reserve with the latest down in Washington. Here's Annmarie. Morning, Annmarie.
Good morning, John. We're seeing the escalation definitely when it comes to the rhetoric. But as you, Danny, and Mike have rightfully been saying, we really don't know where this story stands this morning. The president says he has cause to fire and oust Governor Cook. She says she is maintaining her position. He doesn't have those cause, and she's not resigning. So there's 2 paths that this is going to go down. Likely. One is the legal path. We already have seen Governor Cook attain a lawyer. And if it goes down to as high as, say, potentially the Supreme Court, I would remind our viewers what the Supreme Court said in May, which is that basically the Federal Reserve is inoculated. It is a uniquely structured quasi-private entity, meaning that if there was no cause that while she was in her position and acted with malfeasance and dereliction of duty, then potentially you could see Governor Cook keep her job. Then there's this second path, which you brought up earlier this morning, which is accurate. There's no charge. There's no conviction yet when it comes to this alleged mortgage fraud. We did hear, though, last week from a DOJ official saying that they plan to potentially investigate Governor Cook. So what happens with this investigation is going to be key. Is there actually evidence to these allegations? And if so, and if she is convicted or charged, potentially for the governor, it might become untenable for her to keep that position. And then you're looking at the president of the United States, who has a seat to fill in the Federal Reserve for a board member that term goes to 2038.
Annmarie, tracking developments down in Washington. Annmarie, thank you. Here's the view on Wall Street so far this morning. Stocks inching lower, bond yields inching higher following the latest turmoil at the Federal Reserve. Matt Miskin of John Hancock is following the situation as well, and Matt joins us now for more. Matt, good morning, sir. Love your reaction as you wake up to this news this morning. What is it?
Well, you are seeing the dollar take another bow down to the euro, and really the dollar has just gotten dominated by the euro all year, and it's really a lot of this. It's getting anchored by all this geopolitical uncertainty, this Fed independence uncertainty, and every time the dollar starts getting a bid, like yesterday, it then finds this weakness. And really, as a global investor, it is helping non-U.S. equities have an exceptional year. One of the best years ever, frankly. And with all these tariffs and other geopolitical things that you think would actually weigh on non-U.S. stocks, it is absolutely boosting them. China's near all-time highs, or breaking out at least. European shares are rallying on this. And so, yes, we do have some geopolitical uncertainty developing actually in Europe here. But at the end of the day, that's been the trade as a result of this.
Matt, though the dollar is falling, but barely against the euro. I mean, down just 0.2% versus the euro this morning. Are you surprised that more isn't being priced in with the concerns ongoing?
Yeah, it was down 13% year to date, and now it's come back a little bit, and then today it's dipped. The euro's rallying again. So I think this is in the price to some degree. I mean, we didn't wake up this morning and find out that there's a lot of uncertainty as it relates to geopolitical backdrop here. This has been something that's been happening all year long. We're going back to school here. I've got two daughters, 12 and 9, and we are talking about class participation as an important thing. Well, the United States is failing class participation. Other parts of the world, like Europe, are doing very well on class participation. Now, in terms of grades on tests and quizzes, which actually is where a lot of the final results are coming, the U.S. is doing well. We had the PMIs that just blew out. We have the best earnings in the world in the United States. Yet U.S. equities are massively underperforming on a U.S. dollar basis. European equities, which are up 30, Chinese equities, which are up nearly 30. And so that's where it's showing up. And really, again, it's been a hugely political market this year. It's probably the most politically driven market in history. If you look at the fingerprints that are all over the different movements of markets, and in our view, you want to actually fade that. We're probably amidst an outlier historically, and that's going to moderate over time. It's not happening this morning, but we do think it ends up moderating.
To that point, politics dominating in Europe too, Matt. French equities down more than 1% this morning on the prospect that you could have another government that falls apart just 8 months after the last one did. It's happening through many places in Europe. This concern about fiscal headroom. Matt, does that, at least at the margins, make European equities less attractive despite the outperformance year to date?
Yeah, Danny, it's a good point. And really, it's been multiple expansions. So when you think about what's happened in Europe this year, earnings are growing at about 3%. They were up about 2% last year. So you're getting 2 to 3% earnings growth out of European stocks. To us, that's not that compelling. But the multiple, the valuation of those businesses has jumped massively. Almost all your return has been currency and multiple expansion. And so really that's a sentiment call. Now, what's driving sentiment? Geopolitical backdrop. And so while the French equities are struggling this morning, they are pulling back some. They were never really the leaders as much as Germany and Spain. Those equities are still doing it. European financials are up over 50% this year. The earnings are barely growing, and they're up over 50%. And so really to us, there's a lot of good news baked into Europe more broadly in terms of geopolitical backdrop. There's a lot of negativity priced into the United States as it relates to geopolitical backdrop. That tug of war may actually diminish some, but this morning it hasn't.
So, Matt, let's get into this. Are you saying sell Europe and buy the US or not?
We're actually fading that, John, and because it's the fundamentals. And so if you're an earnings person like us, or if you're a business cycle person, you're looking at the PMIs, August PMIs, the US blew it out relative to the rest of the world. Europe did improve, don't get me wrong, but around 50, stagnation growth in Europe is the new bull market. Whereas in the United States, we're actually seeing booming earnings growth, an improving, accelerating economy. I think actually the back to school shopping, we've helped the economy really accelerate here in August. And that to us is what we're sticking with. We're sticking with higher quality. We're trying to minimize the geopolitical input. But as a market observer, you've got to say what it is And that's what's really driving these markets.
Hey, Matt, appreciate it. Matt Miskin there of John Hancock. Just the prospect of re-acceleration in America. I know we've got difficult, important things to discuss, but Mizuho, Jordan Rochester's talked about it. I've heard others. Bank of America, DJ Barve's talked about it. The prospect that growth starts to pick up into year-end and into 26.
Also, if you think about what the setup will be for early 2026, we're likely to get Fed cuts, as we know. And then you have the one big, beautiful bill. It's so front-loaded for the first half of 2026. That could really provide a tailwind. Any of those sort of recession calls, I mean, they've been put to the side completely. I have seen them start to crop up to say what happens when some of that fiscal fuel from the first half of 2026 starts to run out.
This market has been well supported over the past few months. Equity futures so far this morning negative by not even 1/10%. With an update on stories worldwide with your Bloomberg brief, here's Yahara Anand. Hey, Yahara.
Hi, John. We start with our top story. President Trump is moving to oust Fed Governor Lisa Cook over claims that she falsified mortgage documents. Cook responded saying that Trump has no authority to fire her and that she won't step down. Meanwhile, Eli Lilly's experimental obesity pill called orforglipron helped patients lose 9.6% of their body weight in a second trial that could help move the company one step closer to a potential approval. The success comes after investors were disappointed by the first trial earlier this month, as Lilly plans to file for approval at some point in 2025. And Venus Williams getting lots of support from the U.S. Open crowd despite losing her match in 3 sets yesterday. The 45-year-old tennis legend hadn't played in a Grand Slam for 2 years, but had some big serves and powerful strokes against Karolina Muchova. Williams was the oldest singles player at the U.S. Open since 1981. That's your Bloomberg Brief. John?
Very cool. Yahara, thank you. Appreciate it. Up next on the program, Trump escalating his fight with the Fed.
We haven't seen pressure like this since Johnson and Nixon. It's very significant, puts the Fed in play in a lot of ways, both on the market and in the public's eyes.
Up next on the program, we'll catch up with Michael Townsend of Schwab, live from New York City. You're watching Bloomberg TV. Gape and Morgan Stanley, just hearing from him and the team. They've changed their view on the Federal Reserve. They weren't looking for any cuts in 2025. That has changed. Now looking for a cut in September. This was published yesterday evening before all this stuff overnight. Now looking for 50 basis points of interest rate cuts by year end.
Well, it was a Powell that completely blew the door open into a September rate cut. And the thing is, once you do that and a market prices it in, it's incredibly hard to undo. There's been a lot of commentary that regardless of the data we get the next month, we're still going to get a cut. Maybe the data coming in the next month is more important for what happens later on down the year, whether we get just 25, one and done, a hawkish cut or what have you, or whether we get successive rate
cuts. And it sounds like based on that speech, Danny, we're much more sensitive to the jobs data maybe than the inflation data.
And that feels like a change. It did seem like a Powell and many of the other Fed speakers we had heard from that were putting more emphasis on the inflation data. But Powell really underscored that the thing about this labor market is that there is still so much unknown about it, and it's an incredibly difficult time, and that's why the bias needs to shift to that.
Serious bias shift from the chair of the Federal Reserve. A real shift in the optics of things down in Washington as well. Equity futures so far negative by 1/10% on the S&P, likewise on the Nasdaq 100. Bond yields keeping an eye on the very long end of the curve. 30-year bond yields higher this morning by 4 basis points, 4.93. The surveillance this morning, President Trump escalating his fight with the Fed.
We haven't seen pressure like this since Johnson and Nixon. It's very significant, and it's more direct. It's more public. It puts the Fed in play in a lot of ways, both on the market and in the public's eyes. So yeah, I'm very worried.
So here's the latest this morning. The president ramping up his attacks on the Federal Reserve by announcing he will fire Fed Governor Lisa Cook based on allegations she committed mortgage fraud. With the latest in Washington, here's Bloomberg's Annmarie. Hey, Annmarie.
Hey, Jonathan, good morning. So basically, you have a lot more escalation coming from this Oval Office and this White House when it comes to the Fed. But we wake up this morning really not sure if anything has changed. As Mike McKee has been saying, the president says Governor Cook has been ousted and fired, and Governor Cook says no, she's not, and has no plans to resign and wants to continue to do her job. So where does this leave this story? And I'm glad to say that we are now being joined by Michael Townsend of Charles Schwab. He works on regulatory and legislative affairs. Michael, very good morning to you. Could we just get your reaction on what comes next, given the precarious situation we are in right now and really not knowing whether or not Governor Cook could actually be fired?
Yeah, good morning, Annmarie. Thanks for having me. Obviously an extraordinary situation here with the president's announcement last night. And of course, as you pointed out, Cook saying that she's not going anywhere. I think the reality is we're looking at a lengthy court case that's going to unfold here. And I think that's why the market reaction, at least overnight, has been pretty muted. I think the market is recognizing that this is an extended fight. I do think it adds to the sort of ongoing focus on personnel at the Fed, because not only do you have a vacancy with Stephen Myron, who is going to be nominated to fill that vacancy, that confirmation process is going to play out in September. You have the ongoing chatter about who will replace Powell when his term comes up next year. And now you've got, another personnel situation. So I feel like that's kind of taking away from the focus on the possibility of a rate cut at the next meeting. So there's going to be a lot more to play out. And I think the market is recognizing that this is going to take a long time.
Do you think the market is focusing on this and thinking this is a good thing in terms of Fed oversight, or you think they're looking at this and they're concerned that this is an infringement on Fed independence?
Well, look, I think the market is probably concerned, but I think the market recognizes that this is a story that's going to have to play out in the courts, and we'll see where it ends up. So, I think the market is going to watch that as that unfolds, but I think the market is really keenly interested in the potential for a rate cut, and then, whether there'll be further rate cuts in the further meetings this year. So, in some ways, I don't want to make light of it that it's a distraction, but I think it's a story that's going to take a while to play out, and the market is going to keep its eye on other things along with the unfolding story.
Do you, or are you surprised that the Federal Reserve has yet to put out a statement or respond to these allegations and the president's letter last night?
Yeah, I think the Cook is responding. I expect the Fed will put out something at some point that's backing her. Powell has said many times that he does not think there's a legal basis for firing him when that was a potential worry, and I think that's going to have to play out. So we'll see if the Fed puts out a statement, but I think they're going to continue on their mission of watching the data and trying to determine the direction for potential rate cuts and timing for rate cuts as we move through the final months of the year.
Michael, you're exactly right that this may be a lengthy process, and the market is taking that as this could take months. But what if she is fired for cause, or the situation becomes untenable and she decides to resign? What does the president then do with a governor's seat that has till 2038 in terms of its expiration?
Yeah, I mean, obviously the president can fill a vacancy. We're seeing that play out now with Adriana Kugler's resignation in August and the nomination of Stephen Myron to replace her. That's a process, of course, that takes a little while in the Senate. So, the idea that the Senate is going to come back in September and confirm Myron in the 2 weeks before the September meeting, I find that kind of a stretch, just knowing how the Senate tends to work at a relatively slow pace. And, if there down the road at some point is a second vacancy, then the Senate is going to have to take whoever is nominated for that and go through the process. So nothing happens fast as this unfolds. And I think that, again, the market is recognizing that there are a lot of steps here that are going to have to happen. And, we'll see how it plays out. I think like everyone else, we're going to watch and see what happens.
Does it even matter given the fact that the Fed is lining up to cut rates potentially in September?
Well, I think it matters. There's no question. I mean, who is on the Fed board of governors matters. And as you pointed out, a change in the makeup of the Fed board could also ultimately affect who is are chosen as the Fed bank presidents. and potentially, the numbers and how many votes in the sort of dovish versus hawkish camp are on there. But again, I think speculating about who's going to be where and when is just so difficult in this situation because we're in kind of unprecedented waters. And so, I don't know whether this is going to play out over 2 months or 6 months or longer than that. So we don't know when there potentially will be another vacancy. And, so I think that's why the market is trying to react calmly to this and see how it plays.
Well, the market's obviously looking for some clarity. When it comes to the individuals, though, and that dozen or so names that the Treasury Secretary has been floating for names that could replace Jay Powell, do you find that list credible?
Well, I certainly think it's been an interesting evolution because, at one point it seemed like we were down to 2 or 3 names. More recently, they've said there's close to a dozen names. I certainly think some of the names on that list, whether it's Kevin Hassett or Kevin Warsh, a former governor, are people who have the requisite experience and, will take that job very, very seriously, obviously. We don't know which way the president's going to go. It sounds more recently like it could be multiple months before we know as the sort of interview process that I guess is being run by Treasury Secretary Bessent unfolds. So, we'll see who he taps. But the Fed has a long history and deep expertise. So, having one person come in and completely upend the Fed, I think is hard. I mean, there are, of course, 7 governors and 12 voting members of the FOMC. So, this is a very long game that I think we're going to see here. And we're just going to have to keep watching.
Just want to end on Congress returns. They're back in session next week. What's top of the agenda?
Well, I think the first thing that we're watching is the appropriations process and the potential for a government shutdown. Of course, the government's fiscal year begins on October 1st. Congress is supposed to pass the 12 appropriations bills that fund every agency and every program. They've made very little progress on that so far. And there's just so much tension between Democrats and Republicans that it's very hard to see that process resolving itself neatly in the next month or so. So I do think we're looking at a potential risk for a government shutdown, certainly a likelihood of some sort of continuing resolution, temporary funding measure that avoids a shutdown. But I think a shutdown is very much on the possibility list here, just given the level of hostility between the two parties. So I think that's going to dominate. I also think there's a cryptocurrency bill, the Clarity Act that was passed by the House in July. That's coming through the Senate now, and Senate Banking Committee Chairman has said that they want to move forward with their version in September. So that's something that the crypto industry is really interested in. So I think there's a lot on the agenda that we'll be keeping track of.
Another issue of uncertainty, potentially a government shutdown. Michael Townsend of Charles Schwab, thank you so much for joining us. Jonathan, one thing Michael said there I thought was interesting, different than Henrietta Trey's told us yesterday. He actually doesn't think Steve Myron is going to get that Senate confirmation needed in time to join the next Fed meeting. Henrietta Trey, though, thinks the Senate is going to move quickly and get him on the board.
This is all going to take some time. Annmarie down in Washington, D.C. I think that gentleman did a decent job of explaining things so far. These are serious allegations of mortgage fraud. It's a serious escalation, the president going after a sitting Fed governor. But ultimately, there's got to be space for due process, and this could take months and months and months.
There does need to be space for due process. It gets dragged out. And we also have to underscore that if there are ethical concerns that turn out to be true, it becomes much harder to have that person on the FOMC.
At the moment, no immediate consequences. In the market, we're down by about 0.1% on the S&P 500. In the bond market, bond yields are higher at the long end of the curve. Up next, we'll catch up with the former New York Fed President Bill Dudley on the future of the central bank. Plus, Yahara has your morning movers. Shares of EchoStar surging on a deal announcement. The equity market rally stalling over the past few days. A slow start to a brand new trading week, the final trading week for the month of August. Equity futures so far in the S&P down by about 0.1% now in the S&P 500. On the Nasdaq 100 down by 0.13. In the bond market, lots of changes at the front end of the curve. Two-year yield lower over the past month following a very weak payrolls report, some very negative revisions, and a lot of changes, including from Chairman Powell, setting up a lot of changes on Wall Street too. Deutsche Bank, BNP Paribas, Morgan Stanley, all expecting a rate cut in September, a change of call for those three.
And that's why you're seeing the yield curve do what it is. That is a front end that is coming down and a longer end that's rising. I do think it's notable, though, that where you're seeing the pain isn't really the 10-year. Yes, it's moving. It is the 30-year. If you expected this all to be about inflation and growing debt, you'd expect the 10-year to be doing worse. But that 10s, 30s curve, the steepest since 2021, it's a growing perception that perhaps this is a White House that will do whatever it takes to get mortgage rates down.
We spoke to the Treasury Secretary about this. He was sat in that chair and I asked him about the leakage at the long end. And the problem they've got is this is a global story. You and I have been talking about it. It's France, it's the UK, it's Japan. It's the US as well.
Yeah, by the way, in Europe, part of the story isn't even about fundamentals. It has to do with changes at Dutch pensions. What do you do about something like that? What do you do when what's being driven long term isn't about interest rates, isn't necessarily about debt, but is mechanical issues as well? It's an increasingly difficult long end to get a hold of.
Bond yields at the very, very, very long end of the curve, up by 3 basis points this morning to 492. 2 hours away from the cash open on the equity side of things. Let's get you some morning movers with Yahira. Hey, Yahira.
Hi, John. The deal action keeps rolling, and this time it's in the telecom space. AT&T is scooping up spectrum from EchoStar in a $23 billion all-cash transaction. As a result, we are seeing EchoStar shares soaring more than 60%. The move, according to AT&T, it is meant to strengthen its portfolio across nearly every U.S. market, and it says that this supports its long-term strategy to grow its base of customers that use its home internet and 5G wireless service. If all goes well with regulators, they say the deal is expected to close by mid-2026. Meanwhile, we are seeing shares of Interactive Brokers rising 4% on news that it will be joining the S&P. The changes are set to happen this week on Thursday before the market opens, where it will replace Walgreens, which is set to go private. And we end on Eli Lilly. Shares are rising nearly 2.5% here after strong results from its experimental obesity pill, or Forglipron. Patients with obesity and type 2 diabetes who have a harder time shedding weight lost nearly 9.6% of their body weight and saw better blood sugar. And these results are some of the most closely watched in the pharmaceutical industry because of the potential of the pill to reach new patients like those who want to be on GLP-1s but are afraid of needles. So this all means that Lilly is on track to file for regulatory approval by the end of this year. And if approved, the drug could hit pharmacy shelves by 2026. John?
Yahira, thank you. Appreciate it. More from Yahira later on this hour. On our radar this morning, President Donald Trump attempting to fire Fed Governor Lisa Cook, claiming she falsified mortgage documents. Cook responding, saying Trump has no authority to fire her and that she won't step down. Elsewhere, President Trump threatening to impose new tariffs and export restrictions on advanced technology in response to other nations' taxes on digital services. Trump saying the taxes are designed to harm American technology. It sets up another fight with the Europeans.
It does, but if you have a president whose aim is to champion corporate America, how can you do that without championing our largest companies, which are tech? So in that vein, that totally makes sense. The issue that Trump is likely to face is that Europeans insist that this is a matter of sovereignty. They find these digital taxes so important to them that it's unlikely you'd have the case of Canada, for example, which faced the same scrutiny from the Trump administration and backtrack on some of these digital service taxes. Again, you have a framework in place, you have a deal in place. It doesn't mean discussions are over.
Just how resolved is that deal? To your point, it's never resolved, is it? It's ongoing.
It is constantly ongoing. And it's not even just that. It's also China having representatives in the U.S., concerns about soybeans, concerns about magnets. Every single one of these deals that has been reached, you constantly see a back and forth that doesn't go away. It's continued concerns, and for companies, maybe continued confusion on how to deal with them.
Annmarie said it repeatedly months and months ago. This is a feature of this administration, not a bug, and it will continue through the next several years and maybe even beyond down in Washington, D.C. Wanted to finish on this story. Elon Musk is suing Apple and OpenAI, claiming they unfairly favour OpenAI across iPhones and hinder competition for other chatbot makers. Musk and xAI seeking billions of dollars in damages.
This will be so interesting to see where this goes. A lot of people have looked at this and say, oh, Elon Musk is litigious, of course. I think that's quite unfair considering, remember, the Justice Department sued Google over what they said were illegal payments to Apple to have Google as the dominant search on Safari. It's kind of a similar thing because what's replaced search. It's increasingly becoming these chatbots. So if a judge decided that Google couldn't make its search the main thing on various platforms, then why should Apple, for example, be allowed to force people to use ChatGPT for their AI chatbots? It's a question that, again, it's been faced before the prior types of technology. As it's advancing, the questions don't go away.
That's the latest with that story. Let's turn back to our top story. President Donald Trump moving to fire Fed Governor Lisa Cook. The latest escalation down in Washington, D.C., the pressure building on the Federal Reserve. Bloomberg's Mike McKee joins us now for more. Mike, I want to build on what you were talking about earlier on this morning, that the president's come out and said Lisa Cook is fired, and the Fed governor says, no, she's not. So is she fired? Or isn't she?
We don't know. That is the interesting question right off the bat this morning. If she shows up to work, what happens? Does the Fed keep her out? Does the president send U.S. Marshals to take her out of the Fed? How does this play out? And who takes it to court? We assume it'll all end up in court. And the issue will be the for cause clause in the Federal Reserve Act. Does whatever she did rise to the level of for cause? Courts have generally held that it involves what you do officially on the job, malfeasance or neglect of the job, things like that, rather than personal things that took place before you were nominated to the Fed. But that's a question for another day. First, we got to find out exactly what her status is.
So, Mike, there's some weird things going on here. It's very difficult to track. There's potentially two different tracks. One, you've got legal proceedings that haven't opened up yet and may not, over serious allegations of mortgage fraud. And the other one is whether the president can actually fire a sitting Fed governor. Mike, how are you tracking both at the same time?
Well, we're watching to see what, if anything, the Fed can say. They don't have the facts yet on what Lisa Cook's mortgage situation was, so they're not going to be able to publicly defend her until and if she can show that she is innocent. If she's not, if she did do something wrong, then there's a good chance the Fed might ask her to step down. But they don't know that yet, so they're keeping their distance from all of this. And the administration hasn't said anything since the president put out his statement last night. But we have to watch and see how they follow up on that. And obviously, Mr. Trump has a number of appearances today, and he'll do some stuff before the cameras, and we might find out more.
Mike McKee with the latest. Michael, thank you. Joining us now to extend the conversation, the former New York Fed president, Bill Dudley. Bill, welcome to the programme. Extensive experience at the Federal Reserve inside that institution. How do you think they'll be responding to this morning?
They're going to be very unhappy because this is a real assault on the Federal Reserve's independence. And as we know, central banks' independence is really important for good economic outcomes. There's been a reason why we've been moving in the direction of greater central bank independence over the last 4 decades across the world, because central banks that have independence in terms of how they conduct monetary policy to achieve the objectives set for them by Congress and the administration do a better job in controlling inflation and keeping the economy on a stable path. So this is an assault on that. And I'm sort of surprised that the markets are so relaxed about this. Now, maybe that's because we don't know where this is going to go. We don't know whether Lisa Cook is going to be able to stay in office. It certainly looks like the bar to getting her out is quite high because it doesn't seem that the for cause would extend to the allegations against her. But she certainly, at very minimum, deserves her day in court.
Well, Bill, it seems like that is the system that is emerging, that we're understanding the contours of Fed independence from the courts, be it the most recent ruling that said other independent agencies could have their heads fired by Trump, but not necessarily the Fed without cause. This may be defining, having the courts define what cause is. If you have a system where it's not encoded in law, but instead is being interpreted by the courts, what does that say about the fragility or the stability of Fed independence?
Well, it sort of has to be interpreted by the courts because there's no precedence for this. So we don't really know what the law is until the courts actually rule on it. So the courts have to decide, what's the law intended to do. I think most people think that what Lisa Cook did does not represent for cause dismissal from her governorship, but it's up for the courts to adjudicate that.
So, Bill, if we're in a scenario where it seems like we might be, that this is a Fed that wants to start to ease policy, that it wants to cut, but because of all these proceedings in the background, you get some real tension on the long end of the curve. What would the Fed do in that case? That it wants to cut, it wants to ease, but the markets do something different?
Well, I think the Fed will do what it thinks is appropriate to achieve its objectives on employment and inflation. And Powell certainly signaled at his Jackson Hole remarks that he's worried about the downside risk to the labor market more than he's worried about the upside risk to inflation. And so with his view that monetary policy is currently restrictive, he basically sent a signal that it's highly likely the Fed's going to cut rates in September. And I don't think this changes any of that. What it does change is down the road, when the Federal Reserve acts, when the Federal Reserve, if they cut rates at subsequent times, is that because they think that's the appropriate thing to do for the economy, or because they're under pressure from the Trump administration? Putting a lot of pressure on a central bank is, in my mind, somewhat counterproductive, because it basically causes people to start to wonder, is the central bank doing what is appropriate to achieve its objectives, or is it caving into pressure from the administration?
Bill, you've got great contacts. Do you sense that shift is already underway?
No, I don't think so. I think I think there is a case to cut rates in September. I'm not sure I would be in that camp. I'm not as convinced that monetary policy actually is restrictive today. And I am more worried that the rise in inflation caused by the pass-through of the tariffs end up being more persistent than Powell does. But that's a reasonable point of disagreement. I think that if the Fed cuts rates in September, it's not a big event. The market certainly anticipates rate cuts over the next year. They expect the Fed eventually to cut rates back down to what they view as sort of a neutral federal funds rate of around 3 to 3.5%.
Bill, out of interest, why are you more concerned about inflation? In very simple terms, the Fed chair has basically come out and said he's not worried about upside risk to inflation because of the downside risk to employment. What makes you more concerned?
Well, 4 years of being above your inflation objective. And every year you're above your inflation objective, that increases the risk that people start to view this as the steady state. And then that starts to flow into wage settlements. And then it becomes very difficult to get rid of the inflation that's been embedded in the system at that point.
Bill Dudley, appreciate the reaction this morning, sir. Lots going on. Bill Dudley there, the former New York Fed president. Reminds me of something Lisa Shallard of Morgan Stanley said recently. What are the problems we're trying to solve? Real economic growth remains positive, unemployment modest, financial conditions are loose, corporate credit is flowing.
And by the way, I should note, Kevin Gordon pointed this out, that the city economic surprise index has also risen to the highest level since February. So the economic data coming in has been good. I also think at Jackson Hole is really interesting. Ueda gave a speech that I actually think was very consequential for longer term monetary policy. He talked about an aging population in Japan, keeping rates and keeping inflation higher. John Williams was out recently saying that maybe our start is lower and back where it was before COVID and the outbreak. What's happening in Japan, if this is where the U.S. is headed, suggests that the structural forces actually will mean inflation is higher and maybe continues to be above target. To Bill's point, it already has for 4.5 years.
The comments from John Williams overnight getting absolutely buried by the news on Fed Governor Lisa Cook. Is she fired? Is she not fired? As Mike McKee said, we don't really know what the current circumstances are right now. Where are we? I can tell you where we are in the bond market. No real drama. I said yields are up at the long end of the curve. They are still, but now by 2 or 3 basis points. We're fading some of this move. Let's call it 492 on 30s. With an update on stories elsewhere this morning with your Bloomberg brief, let's check in with Yahara for more. Hey, Yahara.
Hi, John. China is sending a top trade negotiator to Washington this week, a move that signals talks are progressing. The vice commerce minister will meet with trade and treasury representatives Thursday and Friday. The move comes after both sides extended their pause on higher tariffs through early November. Meanwhile, President Donald Trump has called Chicago a mess and threatened to tap the National Guard to tackle crime in the city. Chicago's mayor said Trump's plan is unconstitutional and a threat to democracy. Plus, he noted that murders in the city have fallen to the lowest in more than a decade. And Houston, we may have a problem. SpaceX delayed a critical test of its Starship rocket just a few minutes before liftoff yesterday, citing unfavorable weather conditions. A launch commentator said the company could try again today as Starship is set to take off on its 10th major mission from SpaceX's South Texas launch facility called Starbase. That's your Bloomberg brief. John?
Yahara, thank you. Thank you very much. More from Yahara in the next hour. Up next on the program, turmoil at the Fed.
Whether this changes much, I don't know. But I think the market might be getting wrong. We should stop fixating on rate cuts, what this means for rate cuts. I think, what is this going to do for the longer end of the curve? And what is the Fed and the Treasury Department going to do to prevent, kind of a repeat of last September?
That conversation up next with Jim Bianco of Bianco Research. Live from New York City this morning. Good morning. Well, Dudley, the former New York Fed president, saying he's surprised by how calm this market is in the face of the president firing a sitting Fed governor. And it is pretty calm. We're down by 0.2% on the S&P, not even. We're down by 0.22% on the Nasdaq 100. Under surveillance this morning, turmoil at the Fed.
Whether this changes much, I don't know. But I think the market might be getting wrong. We should stop fixating on rate cuts, what this means for rate cuts. I think, what is this going to do for the longer end of the curve? And what is the Fed and the Treasury Department going to do to prevent, kind of a repeat of last September? I'm not even sure anymore how the market's going to trust whether we get a strong jobs report on September. You would think a month ago we would have sold off hard on yields because, now the Fed can't cut. I don't know that that's going to happen. So I feel the data is going to be noisy.
So here's the latest this morning. Investors weighing potential changes to the Fed's board as President Trump moves to fire Governor Lisa Cook ahead of next month's policy meeting. Jim Bianco of Bianco Research joins us now for more. Jim, welcome to the programme, sir. It's been too long. Do you think this market's underplaying the seriousness of what's playing out in Washington?
Over the near term, no, because I don't think what happens with Fed Governor Cook in the, between now and the September meeting is going to change the outcome of the September meeting, whatever the Fed decides to do, and it looks like they're going to cut rates at that meeting. As you get into next year and you get a new replacement for her and the president now has 4 governors, that could play out in the markets, but that's probably a 2026 story for right now.
Well, Jim, can we sit on the 2026 story? How do you think this might play out relative to what's already priced?
Well, the big thing about this is, we have to go back and look at the Federal Reserve Act and remember that all the Federal Reserve Bank presidents, their terms all expire at the end of February of 2026. They expire every 5 years. Now their boards reappoint them, and the Federal Reserve governors have to approve all of them. Well, if President Trump has 4 governors in place by February of next year, he could have the ability to have them veto any Fed president that he wants and basically kick them out. So we could start to see them start to change the makeup of those district presidents and who's in and who's out starting as early as next year. Now, that's a scenario that could play out, but it's not for sure that that is the scenario that will play out.
Well, I was going to say, Jim, John has made the point this morning that the list of candidates we've had for Fed chair have been very credible. Those that have already been appointed by Trump, very credible. Waller, Bowman, how big of a risk is that really?
That's the question. If we get a credible candidate that looks like they could be independent, and they could, judge where the economy is and what is the appropriate level of policy, then it won't be a big issue. If we get a candidate that doesn't look very credible and would bend to political wishes and try and, change the board mix to accommodate an easier Fed policy, that could be a problem. So it's all still kind of in flux. But right now, you're right. The most likely candidate that will replace Lisa Cook will be the next Fed chair. And all of the candidates that we have, that at least we're talking about, seem to be fairly credible.
Jim, just to play devil's advocate, we are dealing right now with a deficit that is at wartime levels, the highest since World War II. You continue to see borrowing costs move higher because of the movements in this bond market. Why not have a Fed and Treasury that works more closely together? Why not allow the Fed to not necessarily get rid of independence, but work more closely with other parts of this government, just considering the scenario that we find ourselves in?
That's referred to as fiscal dominance. And what that means, of course, is what you said, is that why doesn't the Fed make it easier to pay for government by lowering interest costs so we could have more government? And then if you follow through with that, the Fed could never raise rates ever again, even if we were to get inflation. And that would be a real problem. It would work for a while as long as you don't have inflation. But when you have inflation, the argument would be you can't raise rates to fight inflation because it will raise the borrowing cost of the government. And that's how you get spiraling out of control inflation. So such a move would be something that would end badly. It would only be a question of when it would end badly.
Jim, it doesn't have to be that drastic. I want to pick up on a line of thinking that Danny introduced just last week. If you just look at monetary policy, if they think about the efficacy of their policy at the moment, if they begin to drop interest rates, but you actually see long-end rates stay higher or maybe even creep higher because of what's happening worldwide, don't they have something to think about there anyway? Don't they have to think about what to do at the longer end of the curve?
I think they do, and I think they should, and the recent examples show that. We all know last year when they cut rates, the long end of the yield curve in the United States rose. You can also look at the ECB. President Trump likes to talk about they're cutting rates all the time, and we're not. The long end of the German Bund market or the French oat market is going up while they are cutting rates. Same thing is happening in the UK. And if you want to go even shorter term, since August 1st, 1 minute before the payroll report, the 30-year yield was 491. It's 492 right now. So for all the talk that the Fed's going to cut in September, the bond market's had a month to think about it, and it's up 1 basis point. So it's really trying to signal here that maybe it doesn't want these rate cuts, but it's probably going to get them anyway. And yes, the Fed should be looking at all of these signals from abroad, from last year, and what the current long end of the yield curve is doing now, and really question whether or not it is the right policy, because the bond market is not seem to be on board with it.
Jim, are you questioning as to whether it's the right policy?
Yes, I am. I don't think it is necessarily the right policy. I think we're going to see inflation from both goods prices from tariffs and the population growth slowing because of the slowdown in immigration is going to put wage pressure on the existing jobs that we have right now. And that combination is going to push inflation higher. Now, maybe because the border is closed and immigration is down, you'll see some slowing in the economy, but you might more than offset that with higher inflation. And that's where I think the Fed is going to have to think twice about whether or not they should be cutting rates.
Jim, we were just talking with Bill Dudley, though, who would agree with you that inflation potentially is a bigger problem, but made the argument 25 basis points of a cut in September, that's not necessarily an issue. Do you think it is an issue if they cut in September?
It is an issue if the argument is here's 25 to get President Trump off their back. That's a political move. But if they cut in September 25, you'd have to presume what Chairman Powell has said, that they are restrictive, that the Fed dot plot says that the neutral rate is somewhere around 3%, and that this is the second leg down in interest rates to eventually get them to neutral, and that they're going to keep going. Otherwise, like I said, if the argument wants to be, it'll be a one and done thing just for political purposes, I don't even think that's even a good argument as well.
Jim Bianco, I remember when your name was in the mix to be a Fed governor, and you're a very credible guy. Appreciate your time. Jim Bianco there at Bianco Research. It's good to see you. Lined up to be a Fed governor in the last few years, and didn't happen. We prefer Jim where he is, and we get more access.
Yeah, but it would have been nice also to have Governor Bianco. I think we all would have enjoyed that.
Wouldn't that have been cool? Want to mix it up a little bit?
I'm sure he still would have joined the program.
End the group think? I'm sure he would have. Get live call-ins after the decision.
Oh, yeah, I like that.
Just really shake things up.
Yeah.
Not that they're allowed to do that, but we can change the rules. Up next on the programme, Barry Bannister of Stifel, the former Fed Vice Chair, Lael Brainard, Torsten Slok of Apollo, David Rubenstein of Carlyle. All that and more in the third hour of Bloomberg Surveillance.
So there's an enormous amount of pressure on the Fed right now that cannot be ignored.
This is the toughest position the Fed has basically ever been in.
This is a Fed that's setting up to look through maybe multiple months of some stronger inflation data.
There's a big story in inflation that needs to be spelled out.
We're getting really excited about a cut in September when we've got a lot of data still to come.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores are shaping up as follows. Equity futures on the S&P 500 negative by around about 1/10%. Likewise on the Nasdaq 100. In the face of a storm brewing at the Federal Reserve, this market is pretty calm. In the bond market, 2-year, 10-year and 30-year bond yields. The curve's getting stretched as steeper. We're lower by 2 basis points, call it 3 at the front end. Higher by 2 at the long end, 30s at 490, 2s at 369.
And the reaction is getting more muted as we get closer to the U.S. Open. I was speaking with Ed Cole of Man Group this morning, who said to me the way that the market is interpreting this is more cuts are coming, and that is a good thing. You even see it in the small cap index, which is marginally higher in the future session. But again, we're starting to hear, we heard it from Jim Bianco, we heard it from Bill Dudley, that the Fed might face a problem of optics. That, yes, sure, you get a cut, that maybe the market initially cheers, but if there's an issue where it's seen for a political reason, maybe some of that cheer wears thin.
Do you think that shift is already happening? Now, we asked Bill that question, and Bill said no. He doesn't think it is, but it might in the future. I wonder. I've spoken to a few people already in the past week or so who think the shift from the chair of the Federal Reserve is underpinned by the political pressure of the last month.
That certainly was the argument from JP Morgan's Bruce Caston when we spoke with him on Friday. Because you did see a shift from Powell. The last time he talked about monetary policy, he said it wasn't clear that fiscal conditions were overly tight, that they needed to be more accommodative. We heard something different off of data that was very unclear. So you could, yes, make the argument that there is a credible reason to be cutting. But again, it was a big shift from Powell, which I think is why that question's come up.
We are waiting for more data, and arguably the biggest data point of the week comes from Nvidia after the close tomorrow afternoon. So look out for that. Futures at the moment, no real drama, down by about 0.1% on the S&P. Coming up this hour, we'll catch up with Barry Bannister of Stifel, looking for a stock market correction. We'll speak to the former Fed Vice Chair Lael Brainard as President Trump moves to fire the Fed's Lisa Cook, and Torsten Slok of Apollo with the latest reaction from bond markets. We begin this hour with stocks falling. Barry Bannister of Stifel writing, we expect the S&P 500 to correct 10 to 14% in the second half of 25 as a portion of the stagflation investors feared in the first half becomes a reality. Barry joins us now for more. Barry, it's been too long, sir. Welcome back to the programme. I can understand the discomfort. You're uncomfortable with this rally and the all-time highs we printed only recently. Just extend your thinking on the matter, Barry. Why do you think we end up with the stagflation that people feared?
Hi, good to see you, Jonathan and Danny. This has been the bull market that broke macro, right? So, for example, in the first half of 2025, real or after inflation personal consumption expenditures, 68% of GDP went negative on a year-over-year basis. That never happens without a recession, has ever happened without a recession. So we're a bit taken aback by, the thematic approach rather than viewing stock investing as buying companies. It seems to be more based on purely theme and hopes and dreams. But we're aware of the risks, and we can discuss them if you'd like.
Well, let's discuss them now, Barry. So ultimately, you think we end up in a state of stagflation, which would suggest that maybe the Fed's dovish bias is somewhat constrained. I think what we're all trying to work out is why we ultimately end up in that situation, because this Fed still has very much a dovish bias.
Yeah, it does have a dovish bias, but consider this, using all available data, using the Fed rate that existed, as well as the core personal consumption expenditure deflator data for inflation. The real rate, the rate after inflation, the median since 1946 has averaged 80 basis points, 0.8. It's also in the modern Fed since Volcker collapsed inflation since 1985, it's been 0.85. So, answer me this. If we're going to have more than or around 3% core PCE right up until the Fed chair changeover in May of 26, then explain why the Fed should cut more than twice. Because at that point, they would be at about a 0.7, 0.8 real rate. So all this talk of neutral rates, that's a guess. But inflation, as measured by Bureau of Economic Analysis on the PCE, that is reality. And so I think the market's just a little bulled up on the Fed steepening the curve.
Barry, that's the inflation side of things. But on the growth side of things, how do you look at growth slowing when you have the AI companies spending hundreds of billions of dollars every year on their data center and energy buildouts?
Yeah, that's a good question, Danny. If you look at the actual expenditures, besides the fact that a lot of it is imported electronics and therefore tariff front running to an extent, but it's about 1% of GDP. But on a year-over-year basis, it will follow the free cash flow of big tech. And it looks to us like it's going to actually, on a year-over-year basis, slow down. And since the market just operates on the change in the rate of growth, it's kind of a spent story as far as the incremental impact on the market goes.
So if we do get that correction, Barry, that 10 to 14%, where can you hide out?
Well, when you think about the walls of worry that we're involved in, we're doing a complete revamp of the world trade and financing flows, and we're also more tolerant of inflation in a run-hot administration. AI, I think it's not as scalable as things like software, and as a consequence of all that, some of this hype in the market would probably gravitate back into things like beaten down healthcare, consumer staples, waste management companies, utilities. There are a lot of places to hide. However, in this market, there's not a lot of interest in not hiding. There's a lot of risk taking.
Well, we certainly saw some of that speculative behaviour take place on Friday after that speech from Jackson Hole. I'd love your view on how you describe this regime right now, Barry, down in Washington, D.C. They've just turned the CHIPS Act essentially into an investment vehicle. And we've got a very activist president, investor, sitting in the White House. Barry, how does that change things for you and the team and the way you engage in markets and think about the U.S. economy?
Look, it's not a knock on the administration at all, but there's a little bit of what I would just call an ego trip going on. They're not going to run this. They've already got a hedge fund. It's called the Treasury market and the Federal Reserve, but they're not going to institute a dramatic increase in industrial policy. This was probably more of a one-off. I think there would be some resistance to the government being overly involved in stakes in running U.S. companies.
Not a ton of resistance right now, at least. Barry, appreciate your time and your perspective on the market. Barry Bannister there of Stifel, looking for a 10 to 14% correction in the second half. His points are very valid. And I think to your point as well, and I've been engaging in the same kind of thinking on the matter, you've got the September issue for the Federal Reserve, park that. Then you've got the longer term issue for the Federal Reserve. Think about that a little bit more. If we are getting prints on inflation around 3%, it makes it very difficult to keep on cutting interest rates all the way up until Powell's end of term up in May 2026.
And look, we've been talking about ad nauseum about the long end of the curve. What happens if you do get hot prints and they're cutting at the same time? That just exacerbates the problem that we're already undergoing. And again, it seems like the prints that we're about to get speak not to what will happen in September, because many people have said that it's a lock. It speaks to what happens after September, to your point, John. So the data is becoming increasingly important for that longer term outlook.
Things have settled down. We have to point that out repeatedly, and there hasn't been much drama throughout this morning anyway. But as the US session takes over, bond yields at the very long end of the curve only up by a single basis point now. At the front end of that move sticks, so we're down by 3 basis points. Twos at the moment, 369, which is kind of around the post-payrolls low. The day after, I think the Monday after payrolls on a Friday was the low for the 2 years. So we're around those levels right now.
I'd say it's cross markets, right? So much has happened, but volatility is gone. Bonds are trading in a really tight range. Equities are going nowhere fast around all-time highs. It maybe speaks to the fragility of the moment, but what is the bar to see actual ruptures? It's not the president trying to fire a Federal Reserve governor. So what is the bar to actually see movement in both the equity stock and dollar this morning?
369 on twos at the front end of the curve with an update on stories elsewhere with your Bloomberg brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. President Trump is moving to oust Fed Governor Lisa Cook over claims that she falsified mortgage documents. Cook responded saying that Trump has no authority to fire her and she won't step down. The move represents a significant escalation of the president's battle against the Fed, which he says is taking too long to lower interest rates. Meanwhile, Elon Musk is suing Apple and OpenAI, accusing them of colluding to block rivals in the AI market. In a federal lawsuit, Musk's X and XAI claim Apple's integration of ChatGPT into iPhones gives it an unfair monopoly and deprives consumers of choice. OpenAI dismissed the case as harassment. And a new research report found that AI is making it harder for entry-level workers in the U.S. to find jobs in fields like software development and customer service. Stanford University researchers say they found that over the last 3 years, employment has dropped 13% for people who are just starting out in fields determined to be the most exposed to AI. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. Up next on the programme, the morning calls. Plus, we'll catch up with the former Fed Vice Chair, Lael Brainard, as President Trump looks to fire Fed Governor Lisa Cook. From New York City, this is Bloomberg.
This is a real assault on the Federal Reserve's independence. I'm sort of surprised that the markets are so relaxed about this. Now, maybe that's because we don't know where this is going to go. We don't know whether Lisa Cook is going to be able to stay in office. It certainly looks like the bar to getting her out is quite high. There's no precedence for this. So we don't really know what the law is until the courts actually rule on it.
That was the former New York Fed President Bill Dudley, and this market still looks pretty relaxed in the face of what's taking place down in Washington. Equity futures down by 0.1% on the S&P, and the Nasdaq were down by 0.2. That's the price action. Let's get you some morning calls. First up, Morgan Stanley lowering its price target on Lululemon to $223, expecting the company to lower fiscal year EPS guidance on higher tariffs. Your second call from Bank of America lowering its price target on Salesforce to $325, expecting inline 2Q results that are not likely to be a catalyst for the stock. And finally, Truist upgrading AMD to buy, noting customers were testing its technology as a price check to Nvidia. The stock is up by 2.3%. Let's turn back to the Federal Reserve. President Trump's efforts to oust Fed Governor Lisa Cook intensifying concerns over the central bank's independence. With the latest and a special guest, here's Annmarie. Hey, Annmarie.
Good morning, John. I'm joined now by someone who intimately understands the Fed, was there for 10 years, and most recently was the Fed vice chair under Jay Powell, who is still now the chair. And that's, of course, Lael Brainard. Lael, thank you so much for joining us this morning. As we see this standoff between President Trump and Governor Cook, we have yet to hear from the Fed itself. What kind of response do you think we can expect from the institution?
Well, I think the Federal Reserve is in an incredibly difficult position here, but you have to remember, this is not about an individual governor. This is really an unprecedented attack on the independence of the Federal Reserve as an institution. There is nobody in the Federal Open Markets Committee, the Monetary Policy Setting Committee, that can't be thinking, well, what does this mean for me? And so any member of the board, presumably, is going to worry that they, too, could be subject to this kind of political pressure. And that fundamentally undermines the institutional independence of the Fed, which means higher inflation potentially, less credibility, even higher long-term interest rates. Bad for the economy.
Do you think this can actually impact how members are thinking about monetary policy?
Well, I just think the implication, if any member of that board could come under this kind of political pressure from the White House, and of course we saw that kind of pressure on the chair earlier this year, I think that does really put a higher premium on whether they're going to be willing to speak their minds, to dissent on key votes if necessary. I think it really does create unprecedented risks.
The president in his letter talked about this mortgage allegation, fraud in the mortgage world for Governor Cook. What if she was charged or convicted?
Well, I think what is important here is due process and undertaking a real investigation and having the facts on the table and the ability for her to defend herself legally. None of that has taken place here. The White House has preempted the process, and so that is why it's really unprecedented. It's very, very threatening to the very independence of the Federal Reserve, and it should cause concerns, I think, among investors and more broadly about that fundamental underpinning of our strong economy and our strong financial markets.
Given this is just about one individual, does the Fed come out and say something, or do they need to wait until that due process takes place?
So the Federal Reserve as an institution is all about due process, and there have been individuals who have had investigations previously. There's a good process for doing that. That's not what's taking place here. This is really about trying to overturn the majority of the Board of Governors long before any of these governors' terms are up by threatening them with these kinds of investigations and firing without real due process and cause. And again, the Federal Reserve's independence really is at stake here. And that means that monetary policy will increasingly be overshadowed by concerns that there's political interference, whether or not that is actually the case. If you think about it, Jay Powell opened the door for an interest rate cut in September very clearly. That's exactly what the president wants. So monetary policy is actually moving his way. And yet this is a very, very aggressive attack on the Federal Reserve when monetary policy is doing exactly what he's been calling for.
That speech the Fed chair gave at Jackson Hole just on Friday is very different from how he sounded, Jay Powell, 4 weeks ago. Do you think the speech was political?
Well, I think that the chair was very careful in laying out that the balance of risks had shifted. He pointed specifically to the possibility that the labor market is weakening faster than the members of the FOMC had believed in their last meeting because of the revisions to 3 months worth of hiring data. And so he laid out a very, I think, strong case based on data and the facts why they were now potentially going to be more attentive to that labor market weakening, while acknowledging that inflation is still likely to go up because of the very high tariffs that have been put in place.
Knowing the data and knowing all the personnel that are going to get together at the next Fed meeting, September 17th, do you expect them all to walk through that door that the Fed chair opened up for a cut?
Well, I don't know if all members of the FOMC will be in the same place. And of course, what we should hope for is a really good debate and an airing of differing views. But I do think that barring something really surprising in the upcoming employment print and CPI print, it's more likely than not that they will vote for a 25 basis point reduction in the federal funds rate.
Do you think there's a bias to the labor market in this Federal Reserve?
So up until this point, I think what we've heard is a lot of discussion about the potential risks to inflation. Inflation is still high. You know, it is between 2.5% and 3%. And while this time last year it was going in the right direction, moving down to the 2% target, this year it's actually moving up. So we have heard a lot of attention to inflation. Appropriately so, but the chair acknowledged that they are balancing risks of higher inflation, risks of lower employment, and that is exactly what you expect from tariffs, a stagflationary shock.
When he was talking about tariffs, he said that it's not going to come all at once, the impact. Is the Fed chair basically signaling to the market and to us to just look through any potential hot CPI prints that come out between now and the next 12 months?
So my interpretation of that discussion is simply to acknowledge that when the labor market starts to turn down, unemployment often doesn't gently move up, and the Federal Reserve doesn't have a lot of time to react. Unemployment often jumps higher. Whereas because the tariffs have changed a number of times and still do not seem to be settled, because businesses were so good at getting inventories in ahead of time, because consumers did a lot of advanced purchases, those tariffs are working their way into prices more slowly. So I think it was just an acknowledgement of different potential timing on the two legs of the dual mandate.
It felt like Chair Powell was coming around to how Governor Waller thinks, or maybe how Governor Bowman thinks. And I want to end on those two individuals, their names potentially to be the next Fed chair. But there's a scenario people are talking about that all the president's terms need to be renewed in February. Would you see a situation or risk that the Fed board would nix multiple presidents at the bidding of the president of the United States?
Well, I think that is exactly the risk that we are seeing play out right now. So by moving preemptively to remove a governor from the Federal Reserve without going through the process, without there being any clear evidence, The president essentially is moving to shift the majority of the Board of Governors well before what was contemplated in terms of the institutional structure and their terms, and that opens the door when renewals of all of the Reserve Bank presidents come up in February to again take very unprecedented actions and potentially not renew some of them in order to shift the overall voting majority on the FOMC. That is an unprecedented attack on the independence of the Federal Reserve, and it should really concern us about their ability to continue to be credible in fighting inflation and keeping our economy on a strong course.
But just quickly, you know Governor Bowman and Waller. Do you think they would be up for that kind of level of revamping?
So this is really not about individual members of the board or the FOMC. This is really about whether political pressure will continue to be exerted on all members of the FOMC in a way that puts them in jeopardy and potentially makes them less willing to share their views about the economy and appropriate monetary policy with the public, and also to vote their mind on monetary policy decisions. That is what is at stake here, and I think it's very concerning.
Lael, thank you so much for your time this morning. Jonathan, of course, that was the former Fed Vice Chair, Lael Brainard. She, of course, also went on to then work under the Biden administration as President Joe Biden's NEC director. What she's saying there is this really is not an attack on an individual. She thinks this is an attack on the institution.
Annmarie with the latest in Washington. Annmarie, thank you. The conversation is going to continue. Fantastic lineup to close out the programme this morning. In just a moment, we'll catch up with Torsten Slok of Apollo with the latest reaction from the bond market. Plus, we'll speak to Yahara to get your morning movers. Eli Lilly shares jumping in the pre-market as its weight loss pill moves ahead. The stock is up by 2.5%. Equity futures on the S&P 500 negative this morning by just 0.1% on the S&P. On the Nasdaq, the main event is tomorrow. Nvidia earnings after the closing bell. About 8% of the S&P 500. Its weighting on the Nasdaq 100 is about 10%, and it probably amounts to about 110% of investor sentiment. In the bond market, 2-year, 10-year and 30-year bond yields shaping up as follows. The curve is steeper. Danny's been talking about it all morning. Yields down at the front end, up at the long end, up 2 1/30s to 4.91. Here's the state of play 60 minutes out from the opening bell. Equity futures negative by just 0.1% on the S&P 500. On the Nasdaq 100 down by 0.14. In the bond market, 2-year bond yields are lower, 30-year bond yields are higher. This curve is steeper. We're down 3 at the front end, 369.58. We're up 2 at the long end, 4.91. This debate at the front end of the curve. Chairman Powell's speech on Friday solidifying where this Federal Reserve is heading in September and maybe beyond, and the additional pressure overnight is certainly not changing the direction of travel.
It's not changing the direction of travel because one of the market's big takeaways, and I think the thing you can hang your hat on, is this is a Federal Reserve that is moving in a more dovish direction. Everything else is going to take so long to play out. It's going to take a long time to understand exactly what Governor Lisa Cook's standing is on the Fed, whether she's going to have a vote going forward, whether there is some real threat to independence. Again, the one thing that you can hold on to is it's a Fed that's going to cut it.
This is going to take some time, as Danny pointed out, which is why this market is somewhat relaxed about the issues at the moment. With 60 minutes until the cash open, let's get you some morning moves and cross over to Yahara for more. Hey, Yahara.
Hi, John. We start with the chip maker AMD. Shares are rising 2.7% after announcing a partnership with IBM on quantum computing. This is an area that IBM has been focused on, and now AMD will supply the chips to help make it happen, with the company's planning on a demo for later this year. It's also getting an extra boost after analyst Will Stein over at Truist gave it an upgrade. Meanwhile, we are seeing shares of Eli Lilly also rising here 2.5% after strong results from its experimental obesity pill. Patients that took the drug lost nearly 9.6% of their body weight and saw better blood sugar as a result. And these results are some of the most closely watched in the pharmaceutical industry because of the potential of the pill to add new patients who want to be on GLP-1s but are afraid of needles. This all means that Lilly is on track to file for regulatory approval this year and that we could see these on pharmacy shelves by next year. And the deals keep rolling. This time it involves this company, Olaplex. Shares are up 2%. This is a hair care company that makes shampoos, and it is making its first ever acquisition. It announced it is buying a U.S. beauty-focused biotech firm named Pervala to boost R&D. This adding to the deal news we heard earlier from AT&T and a flurry of action yesterday. John?
We've seen a lot of deal making over the past week, that's for sure. Yahara, thank you. Appreciate it. Let's turn back to our top story. President Donald Trump moving to fire Fed Governor Lisa Cook. We still don't know if she can enter the building this morning. Mike McKee has more for us. Good morning, Mike. What is the latest?
Good morning, John. Well, we don't know if she's even in town in Washington and trying to enter the building, but it is an open question right now. We're also waiting to find out whether or not somebody goes to court. Would the president go to court to try to get her out of the building if she goes in? Will she seek an injunction to prevent herself from being fired? All of that is up in the air, as is what happens going forward when the courts have to decide on this issue. Does the Fed have a carve out on the for cause? And then would she meet the for cause label? So there's a lot of questions out there right now. At the same time, you've also got the Fed on track to cut rates in September. People keeping an eye on that. And that, in theory, would not change one way or another with Lisa Cook in or out. And she would probably vote with the chair, who suggested it may be time to cut rates. We just had durable goods orders come in reasonably strong, down 2.8%, but that was largely a drop in Boeing aircraft orders, 32% drop there. Most other categories up, and the core capital goods orders, non-defense ex-air, were up a fairly strong 1.1%. So there's still some strength in the economy. The Fed's going to have to figure out if that's enough to prevent a rate cut on September 17th.
Yeah, Mike, if we don't get a rate cut on September 17th, I imagine fireworks, not the right kind, taking place down in Washington, D.C. Before we get to all of that, Mike, in the last hour, we spoke to the former New York Fed president, a man you and I both know well, Bill Dudley. Bill was surprised with how relaxed the market is this morning. Mike, I'd love your impression of things, your reaction to the lack of market reaction.
Well, we're all surprised by that a little bit, but I think really what's going on is that the markets aren't thinking that Trump can get away with it right now, and that they are concentrating on the idea that the Fed is going to cut rates. And so they're getting what they want going forward. Now, the yield curve has steepened, as Danny's been talking about, and that is a sign that at least the bond side, the fixed income side, is concerned about what could happen here.
Mike McKee with the latest. Mike, thank you, sir. Joining us around a table, Torsten Slok of Apollo. Torsten, good morning.
Morning.
Your reaction to this one?
Well, obviously, the market reaction here is a little bit surprising in the sense that the stock market is basically now unchanged, at least before we open. But what you're seeing in the long end is certainly somewhat worrisome. The yield curve is steepening, telling you that the market is expecting that rate cuts are coming, because this seems to be at least more likely given recent discussions, including Jay Powell on Friday, but also that the long end has moved higher. Is obviously equivalent to beginning to think about that maybe there is a risk that inflation is going to be a problem for a longer period than what people thought just a few days ago. The conclusion from a broader perspective is obviously a discussion around, well, maybe we should just begin to think about when we say rates are higher for longer, that maybe it's long rates that will be higher for longer, not only for fiscal reasons, but also now because of this emerging debate, not only because of what Powell said last Friday in Jackson Hole about the framework, but also about this issue now about, well, what will the composition of the FOMC look like? Are they going to allow essentially the inflation target to be higher than what it has been just for the last several years?
Torsten, really zeroing in on the shape of the yield curve, though, and talking about duration getting hit, it is the 30-year yield. It's a 10-year yield which hasn't moved as much, and you'd expect if the issue is more persistent inflation, the 10-year yield also would be moving higher. 10's 30s curve is the steepest since 2021. Why is the 30-year yield specifically acting as the release valve?
Well, there's just more sensitivity in the form of duration in the very long end. So 10-year rates, of course, are not down as much as 2-year rates are. So really, it is the whole yield curve that is just steeper. And you're right, the 10-year rate basically being only down a little bit here as we speak is certainly also telling telling us that it really is the very long duration exposure. Those with very long duration exposure relative to matching their long duration liabilities, they are the ones that are reacting to this, mainly worrying about that 30-year is where most of the action has been. But you're right, it is a little bit peculiar. We look at it here and say, well, why are 30s moving so much more than 10s? But I think it is just a reflection of the whole yield curve steepening here that is going to take some time now to digest. And as Mike also was just saying, well, what exactly will be the scenario we have now ahead of us? Is this going to change the composition of the FOMC, or what will the FOMC then look like, especially when we come to the other side of February next year?
So is it your assumption if we get more doves appointed to the FOMC, more people who are maybe willing to listen to the arguments of the White House, that it's the inflation target that changes, that that's the main mechanism?
I absolutely think that we should all think of this as essentially a change in the inflation target. We have now for 30, 40 years been used to the inflation target is 2%. If I own treasuries, my fixed income portfolio will be eroded by 2% every year. And if inflation now is allowed to be higher for longer, and if Jay Powell now last Friday said that the change in framework away from flexible average inflation targeting also will allow inflation to be higher for longer, that means that bond investors should begin to think about that it is simply the same as saying that the inflation target will also be higher. Not necessarily significantly higher than 2, but even if we go up to 2.5 and 3, over time, that's a fairly significant erosion for fixed income investors, especially in public markets.
Torsten, these are really important, critical, serious points. But this has happened independent of the pressure on central bank independence. The whole point of central bank independence is to make the tough decisions, divorced from the political cycle, to make sure that you hit your 2% target. So what is the excuse for Chairman Powell and the Federal Reserve to miss this target for so many years?
Well, the issue, of course, at the moment is that normally the dual mandate, meaning inflation and unemployment, normally points in the same direction. If you have a strong economy, the unemployment rate goes down, the inflation goes up, and you should hike rates. If you have a weak economy, the opposite happens. Of course, inflation goes down and growth goes down. Of course, you should be cutting rates. Now there is this tension in the dual mandate, and that is what brings this discussion to the table. Namely, that now the dual mandate is pulling in different directions. Inflation is saying the Fed should be hiking. And if we have upward momentum, if I look at ECFC go on my Bloomberg screen, the consensus expects inflation for the next 12 months to be 3% for the next 4 quarters. That's a very high level of inflation when the target is 2. That says that the Fed should even consider hiking rates. But at the same time, Powell very clearly last Friday said, no, we're now going to put much more weight on the slowdown in the labor market. And with the anchoring in the long-term inflation expectations, that could be the excuse and the reason, the small door out of saying, well, maybe we don't need to worry so much about inflation. Maybe we can focus more on the labor market. So the answer to your question is, it's because of the tension in the dual mandate, that one part of the dual mandate says they should be hiking and the other part says they should be cutting. And that's what brings this discussion to the table at the moment about what exactly is the best decision.
As you know, the way they're addressing that at the moment is to say, essentially, and this is coming from the Fed chair, Governor Waller shares this view, the labour market's not sufficiently tight enough to worry about second-round effects. That this inflation story will ultimately be, they won't say it, but they're basically spelling it out, transitory. Would you push back against that?
Well, the risk is that we don't know if that's the case. Beth Hammack at the Cleveland Fed has been pointing out that companies in her district are beginning to raise prices, even those that are not impacted by tariffs. So the risk is also in services inflation. Services makes up 2/3 of GDP, and the ISM prices paid in services has really started going up. And that suggests that even, and Austin Goolsbee was also pointing to this, that even the service part of the CPI index could begin to show some upward pressure. So we just don't quite know if we're out of the woods on the inflation front. So that's also why inflation swaps in 12 months' time are pricing that inflation will be, in 1 year's time, 3.4%. That is dramatically higher than the Fed's 2% target. And that is the fear, of course, that some people in the market have, namely that maybe inflation is going to be not only transitorily higher, but maybe there is a risk that it could be more permanently higher, in the sense that we will have inflation higher for longer. And that's, of course, the risk that we could have a policy mistake here by focusing too much on the labour market.
Well, let's talk about how policy might evolve. There's 3 time frames to think about here. Danny talked about 2 of them a little bit earlier. There's September, then everything else. But there's September, everything else, and then there's life after Powell from May onwards. And I just wonder whether you think perhaps we're getting ahead of ourselves here, that beyond September, there's still a lot to play for.
I do think that it's a good idea to take a deep breath and go for a long walk in a green park and say, you know what?
Touch grass.
There's a lot of things going on at the moment, which, of course, are somewhat unusual, including, of course, the topic of the day. But let's see what the data is telling us. We have a lot of data points before we get even to the December meeting. So the market is currently only pricing a cut here in September and December. But getting into next year, the economy could be in a very different place. We could either have a scenario where inflation is a lot higher and we have a whole different discussion, but it could also be a scenario where we have growth slow down slowdown that's a lot weaker, and therefore the Fed will be cutting a lot more. So let's take the data as it comes in and watch exactly how it plays out relative to the dual mandate for the Fed.
Well, Dudley talked about the same thing. If you're in the threes going into 2026, this gets harder and harder to cut.
It does get a lot harder, but I think it's going to be really instructive on Thursday. Governor Waller is going to be giving a full-fledged monetary policy and economy speech. Considering Powell's come around to his camp and he's up for the Fed chair, I think that's really also going to determine maybe that medium-term plus longer-term trajectory of the Fed.
And then Powell can take notes and basically use the same notes in the news conference, which is basically what the speech was on Friday. Anyway, less of my snark. I want to finish on with you, where you think this is ultimately heading here. Do you believe we do end up in this situation where we are facing stagflation and this Federal Reserve is ultimately paralysed and that dovish bias is constrained? Because at the moment what we hear is the dovish bias isn't constrained. Do you think that's the ultimate destination, though?
I absolutely think the ultimate destination, exactly. Because the issue is normally Fed policy is very straightforward because both parts of the dual mandate are actually designed to point in the same direction with the business cycle. When the economy is good, you should be hiking. When the economy is bad, you should be cutting. But now, because of this stagflationary impulse coming not only from tariffs, but also coming from immigration restrictions and deportations, lowering labor supply and putting upward pressure on wages in the sectors where unauthorized immigrants are working, namely agriculture, construction, hotels and restaurants, that stagflationary impulse is creating this very complex situation for the Fed, where it becomes a matter of, do you like apples? Do you like oranges as the Fed chair or as the FOMC? Do you like inflation? Or do you like the slowdown in growth? And where do you put your weight? And that does indeed depend a lot on what is the composition of the committee.
Torsten, good to see you. As always, good to talk to you all morning, as always. Torsten Slok there of Apollo, breaking down the latest situation. Breaking down the market right now. Futures just a little bit softer. Bond yield at the long end just a little bit higher. With an update on stories elsewhere with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. Wildfires in California and Oregon prompting thousands of evacuations. In Oregon, the flat fire is just about 5% contained. Meanwhile, the Picket fire in Northern California is 15% contained and has so far spared wine vineyards in the area. But it has burned nearly 7,000 acres since it started last week. Meanwhile, shares of EchoStar are soaring more than 70% after AT&T agreed to purchase certain wireless spectrum licenses for approximately $23 billion. The two have also agreed to enhance their long-term wholesale network services agreement, enabling EchoStar to operate as a hybrid mobile network operator, providing wireless service under the Boost mobile brand. And in sports, top-ranked players continue to dominate in the first round of the U.S. Open, with Carlos Alcaraz and Frances Tiafoe both winning in straight sets. World number one Jannik Sinner takes the court later today. For the women's tournament, American Madison Keys fell in the first round, and top-ranked American Coco Gauff plays later this evening. That's your Bloomberg Brief. John?
Alcaraz looks like a UFC fighter now. New haircut, you seen that? Shaved head, buzz cut?
I thought you were saying because sometimes when he practices without his top.
Well,
it looks really buff,
he looks shredded as well.
Yeah.
But now with the shaved head, we're sort of like taking an extra step anyway. Good luck to him later on. Up next on the programme, we'll set you up for the day ahead. Plus, David Rubenstein of the Carlyle Group as President Trump moves to fire the Fed's Lisa Cook.
I think the Federal Reserve is in an incredibly difficult position here, but you have to remember this is not about an individual governor. This is really an unprecedented attack on the independence of the Federal Reserve as an institution, which means higher inflation potentially, less credibility, even higher long-term interest rates, bad for the economy.
That was just moments ago, the former Fed Vice Chair, Lael Brainard, joining Bloomberg Surveillance in the last hour. It's our top story this morning. President Donald Trump attempting to fire the Fed Governor, Lisa Cook. Joining us now to discuss, David Rubenstein of the Carlyle Group. David, welcome to the programme, sir. Welcome back, I should say. What a moment for Washington, D.C. This president is not scared to intervene, whether it's taking an equity stake in Intel or attempting to fire a sitting Fed governor. David, you've seen it all in your time in Washington and on Wall Street. How would you describe this moment in the nation's capital?
Well, obviously, this is a time of first impression, as lawyers would say. We haven't seen this before. The Federal Reserve has never had somebody fired by a president of the United States before, as far as I know. The Federal Reserve was set up in 1913. So this is a very difficult situation. We don't know what the outcome will be. Lisa Cook has said she's hired a lawyer, a well-known lawyer in Washington, D.C., and she's presumably going to fight this, so it will probably be resolved in the courts.
David, it's a market that's little reacting to that. Maybe some in yields, little in equity. You've worked with countless companies over your career. When there's this level of uncertainty in Washington, D.C., be it tariffs, be it D.C., as John was saying, be more active in taking stakes in companies, what is the playbook?
Well, obviously, markets like certainty. They don't like unpredictability. But many of the things that President Trump has been doing are things he said he would do. And many of these things are relatively predictable in the sense that he said he wants to make changes in the Federal Reserve. So I think the markets are not as upset about it as if some other president were doing it. And I think the markets will absorb it. We don't know how this is going to get resolved, but clearly what's going on is an effort to lower interest rates on the part of the president, and he believes strongly that that's a desirable outcome, and he's told that to Jay Powell. And I suspect we'll be seeing a lowering of interest rates at the next Fed board meeting. Jay Powell more or less telegraphed that when he was out west recently at the Federal Reserve meeting out west. So I think that the markets are anticipating a 25 basis point cut. Jay Powell is pretty good about telegraphing what he's going to do and then following through on it. So I would be surprised if we don't get a 25 basis point cut, and very surprised if we get a much bigger cut.
Fair enough, David. I mean, what is overall your read on both the threat of credibility of this institution and the independence of this institution? How fragile or not is it?
Well, the Federal Reserve is one of the most respected institutions in Washington. I'd say that perhaps the two most respected institutions overall in Washington might be the Supreme Court over many, many years and the Federal Reserve since 1913. And I think that both institutions have their challenges from time to time, but I think that their strength and their reputation over a period of time will stand them in good stead. So I don't think the Federal Reserve is going to fall apart over this. The Federal Reserve is very important. Its independence is very important. But I think in the end, this will probably get resolved in some type of settlement or some type of out-of-court process. So I don't think it's going to be a big surprise how this gets resolved. And I think in the end, when the president makes a decision about who the new Fed chair is going to be, I think the markets will be relieved to see who he's picking. And I suspect he will make some announcement in the not-too-distant future. And that person presumably will lower interest rates, as the president has indicated he wants the next Fed chair to do.
And David, the list of candidates is very credible so far, at least. Attitudes towards markets don't seem to have shifted too much. Stocks are very close to all-time highs. Credit spreads are still incredibly tight. From the people you speak to, the large investors, from the outside looking in, internationally, looking at the United States, have you noted a shift in attitudes at all, or have things settled down?
Around the world, most investors understand that the president is somebody that likes to shake things up, and he will do unconventional things, and the markets have gotten used to that. The markets are very high right now, and therefore the markets are not all that upset about what the president's doing because they understand that's his modus operandi. So I think that the fact that markets are so high shows that people are not afraid of what the president's doing. In many cases, people think what he's doing is a good idea. In some cases, people don't. But I don't really think the markets are running away from him, and I don't think the markets are falling apart because of what he's now doing in a number of areas like the Intel matter or the Lisa Cook matter. They'll get resolved in some manner that I don't think is going to be too disruptive of the markets.
David, we're looking forward to the next episode of Bloomberg Wealth. Of course, it airs tonight. I understand you sat down with the T. Rowe Price CEO, Robert Sharps. He spoke to you about active versus passive management. He also has a major stake in the future of the city that is dear to your heart, the city of Baltimore. Can you walk us through the discussion that you two had?
Sure. Robert Sharps runs T. Rowe Price, which is about a $1.6 trillion asset management company. It's basically more actively managed than passively managed, and they've done quite well over many, many years. I should point out that he's a sponsor of the Baltimore Orioles, which I'm a principal owner of, so I have a partial feeling towards his company, and I should disclose that. But he's done a very good job of working his way up from being an analyst there and a fund manager to being the CEO, and the company's done pretty well under his management. So I think it's a company that many people put their 401k money in and other types of money into their funds, and I think they've done reasonably well from what I understand.
Full disclosures, David, we're still waiting for baseball tickets. Where are they? What happened? I thought we were going to have a big get-together. Bloomberg Surveillance on the road, coming down. You were going to host us. What happened?
Well, I'm waiting for next season. This season didn't work out quite as well as I would have predicted. Injuries are a bigger problem than I anticipated, but I'm going to try to, get people not to be so injured next year, and maybe I'll, show them some batting tips or pitching tips myself.
I'm sure they're looking forward to that. David, appreciate your time. Thank you, sir. Thank you very much. David Rubenstein there of the Carlyle Group. You can watch the latest episode of David's show, Wealth, on Bloomberg tonight at 9 p.m. Eastern Time.
Sorry, I just imagine David also becoming like a personal trainer to them too, trying to make sure that they're not getting injured. I hope that for David and the Orioles too.
They play too many games.
They play so many games.
It's ridiculous.
It is, but I mean, hey, the schedule demands it. Media rights are hot. Everyone's bidding it up. So I don't know if that's changing anytime.
It's the same with football, isn't it? Anyway, let's round up the price action so far this morning. Things have been okay. Equities are all right. We're down about 0.1%. We've seen a move in bond yields. I know why people are so concerned about the future of the Federal Reserve. We can all agree. Central bank independence is vital. It anchors inflation expectations. It contributes to lower interest rates. Got all of that. But at the moment, things are okay. No drama on Wall Street, even with the drama in Washington.
Things are okay because we just frankly don't know how this is going to play out. This is likely going to be a court case. It's likely going to take a very long time, months, if not more than years. There's so much uncertainty, and we've seen what's happened when this market trades on what it thinks is going to happen with this White House. April 2nd, a great example of that. Things sell off, and then they come roaring back. So why make that mistake twice?
Danny, appreciate your time. It's good to see you.
Thanks for having me.
As always, long morning for you. We appreciate it. Coming up tomorrow, Ian Steely of JP Morgan, the former chief of staff to the former Vice President Mike Pence. We'll speak to Mike Short. Alex Altman of Barclays and Matt Lazzetti of Deutsche Bank. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.